Good morning and welcome to the September Private Company Council meeting. We're following our regular agenda. As you know, yesterday afternoon, we had a brief public session that discussed the interactions we'd had with the AICPA Technical Issues Committee, which, as you know, is an important constituency for us in getting feedback about the marketplace and their views on accounting matters. But now we're going to kick off and go for it, starting a little early, and hopefully we'll be out of here on time. So with that, Jennifer, why don't you give us topic 1 on the town hall and liaison meetings?
Great. Thanks, Jerry. Good morning, everyone. Those will be shown on your slide here momentarily. There are several upcoming PCC liaison meetings taking place from October through February of next year. All meetings are currently in the process of being planned. I'm just going to quickly run through the list. We've got an October meeting with ProSite Financial Association Accounting Working Group. This is a formerly Risk Management Association. And then Construction Financial Management Association Emerging Issues Committee, the Auditing Standards Board Audit Issues Task Force, the Institute of Management Accountants Small Business Shared Interest Group, having a liaison meeting with the surety industry, which would include folks from the National Association of Surety Bond Producers and Surety and Fidelity Association of America. And while not on the slide, we're also in the early stages of working with AICPA representatives on having a liaison meeting with the G400 community. So as you can see, these meetings will encompass all types of private company stakeholders, financial statement users, preparers, and practitioners. We appreciate the willingness of all of these stakeholders to engage with the PCC and share their perspectives. And after these meetings take place, the feedback will be summarized and discussed at subsequent PCC meetings. So I know that was brief, but I'll pause there for PCC members if they have any questions or comments.
So I'll comment. I think these are an important element of us being, both visible and recognizing that listening in the marketplace is an important part of our responsibilities to advise the FASB. And, we look forward to hearing from other groups that might want to meet with us, state societies, other industry teams. And so feel free to reach out to Jennifer. If you're a group out there that thinks that hearing about the PCC and what we do might be important to you and your constituencies. Okay, so topic 2, the agenda priorities. As you know, we can at every meeting we've talked about what we should be working on and how we're going to consider it. And as the day goes on, there's a number of items we're going to go through that the council has concluded we wanted more research conducted and we wanted more feedback about these topics. In June, there were a couple of items that we, after initial research was done, we concluded we should not move forward with them. And there could well be other things that we talk about today that we reach that same conclusion. But for now, my expectation is the things that we have live are going to continue to move forward. And we'll figure out whether there are any recommendations we might ultimately make about how private company standards, might be adjusted or made simpler. With that, why don't we jump right into a topic that we had a lot of vigorous discussion with the TIC yesterday on subjective acceleration clauses. Jen?
Thank you. So as a reminder, at the June PCC meeting, members discussed private company stakeholder feedback on the guidance on subjective acceleration clauses in determining the classification of debt as a current or non-current liability in a classified balance sheet. Multiple PCC members supported moving forward with certain previously proposed amendments from a prior board project, which was not finalized, and use that as a starting point. PCC members also had a preliminary discussion on potential solutions for private companies. Since then, the staff has conducted further research on potential private company accounting differences in areas that the PCC should consider as you all continue your research. Those areas include guidance on the probability assessment, intent and ability to refinance short-term debt on a long-term basis, revolving credit agreements with subjective acceleration clauses, and enhanced private company debt disclosures. So the first area of discussion is the probability assessment guidance. Under topic 470 debt, an entity must assess the likelihood of acceleration of the due date of debt in determining current or non-current classification when a subjective acceleration clause exists in a debt arrangement. Amendments previously proposed by the board for all entities would have removed that probability assessment, and instead a subjective acceleration clause would have affected debt only when the clause was triggered. Those proposed amendments were never finalized due to issues unrelated to subjective acceleration clauses. During the June PCC meeting, members preliminarily supported removing that probability assessment guidance, and instead, that clause would affect the classification of debt only when it's triggered. Additionally, several PCC members supported research on classifying debt as a current liability once a subjective acceleration clause has been triggered. Now, during the PCC's meeting with TIC yesterday, TIC members provided input on most of the questions that we will also have a dialogue with the PCC today. In particular, I wanted to mention there was a robust discussion on whether the description of triggered included in paragraph 42 of your memo is the right description. TIC talked about some of the potential issues in interpreting and applying that description. So this is an area that the staff will certainly need to do some additional thinking and outreach with stakeholders to make sure we get it right and that the description is operable. So we would like to hear from PCC members today on whether the description should revert back to what was included in the prior proposed amendments, which is included on paragraph 30 of your memo, or what other suggestions you might have for the description of trigger. So with that, we'll move into questions 1 through 3. Question 1 asks, do PCC members preliminarily think that the probability assessment guidance should be removed and instead a subjective acceleration clause would affect debt classification only when triggered? Question 2, I just mentioned, that's about the description of trigger. And then question 3, do PCC members preliminarily think that once a subjective acceleration clause is triggered, the debt should be classified as a current liability? So with that, I'll pause for discussion.
So just to clarify, in paragraph 30 of the memo, and I'll abstract what it says, but a subjective acceleration clause was considered to be triggered when a borrower is notified by a lender of non-compliance, including notification that occurs when the lender demands payment. And I think that might be some wording that I think we have some varying views on what that entails. So I'm interested for the group to have a dialogue about, first, let's talk about that paragraph and then where we might go if that's not a paragraph we think meets all of our requirements. Sure.
Yeah, and then in paragraph 42, I want to just distinguish between, there's 2 descriptions of triggered in your memo. The one that Jerry just read is what was proposed or what was included in the proposed amendments a few years ago. What's in paragraph 42 is a different description of triggered. There's some words that were added to that description based on input that we got from PCC members in June.
David Hoagland? Robert got his hand up first, sorry.
Well, we're both users and we're pretty passionate about this topic, so it's pretty easy to speak up on. Question 1 about the probability assessment. I really kind of like the idea of auditors and preparers and those guys having to let us know if they think this is possible or something that could happen. So I like that. But I've listened carefully over the last couple of days and talking to different people. I think that's a huge burden to place on everyone to make that determination. So I think that can be something that we can live without and not put that burden there. But I think a better understanding of what triggers would be and what they would look like would be very, very helpful. And I don't know, there may not be only one trigger there because things are different for different instruments and different kinds of things. So there may need to be several descriptions of triggers, and it may be a qualitative decision on what that would look like.
Thanks, Robert. Brad?
Yeah, I would also answer yes to question 1. I think question 2, Tick had brought up some concern about those additional words that were added on to the definition in paragraph 42. I would agree with Tick's that their concerns relating to these words of denies access to funds of an existing long-term agreement. That paragraph suggests that would also qualify as a trigger. In my mind, these are two different things. If I'm denied access to funds, that could be an adverse business condition worthy of disclosure, but I don't agree that that would then require classifying debt that is not required to be repaid in the current year to be classified as though it is. And so I would favor the old paragraph rather than the new paragraph.
David Pesh?
Yeah, and I think also when you look at this, you have to consider the type of arrangement that's underneath. So I don't like the denial of access to funds piece of this. I think it needs to be dug into deeper, particularly when you're talking about revolving credit facilities that may have a borrowing base underneath it. So your denial of access to funds could simply be your borrowing base decreased. So you can't get it, but you're in no way subject to any other aspect other than you can't get it. So if we're going to have anything related to denial of access to funds, it's got to be very specific that it's going to be a denial of access of funds and a trigger for demand. And I think really that's the other area we need to look at. It has to be a trigger demanding repayment, not a trigger of just, hey, by the way, this is going on in your company, and don't forget we have this ability if we so choose. So, if we're gonna consider it that way, we've really got to look at how we're going to define that trigger. I think it's I think it's better, but it's still not perfect yet.
Thanks, David. David H?
Yeah, it's like the third or fourth lender in the room, right? It's going to be no surprise, but I agree with Dave Pesh, right? Like this needs to be very specific to, we would go through a lot of evaluation, talking to counsel to issue a demand letter. So it has to really be a demand letter because we feel confident we can, stop the funding, won't be liable for, quick, requiring them to repay the debt and those sorts of things. So I think it'd have to be very specific to that. The funding piece, obviously every revolving credit, I shouldn't say every, there's always an exception, but whenever you ask for more money, there's usually a MAC or some sort of subjective clause. May or may not be different from the one that exists, that you're repping to either on a quarterly basis or ongoing all the time. So, but they're all spelled out in the credit agreement. And so if someone's looking at the credit agreement, they could see whether it's a incurrence type of test when you're incurring new debt or if it's an ongoing test. So I think they're all specific enough that you could determine what part of the credit agreement those come from and whether or not you're bringing the debt current. So it's going to be pretty specific.
So in that regard, there would be objective criteria that one could look at relative to this subjective call.
That's right. If you're doing fundings, right, it's going to be in the condition precedent to funding. If you're looking at just ongoing, I'll call them covenants, but material adverse change or effect, those are just going to be in every quarter or ongoing. It's going to be very specific to that part of the credit agreement. So I don't think there's going to be a lot of confusion between the two. One might get negotiated out versus the other may still be in there.
Great, thank you. Adam?
Yeah, thank you. Starting with yes, preliminary, I think my answer is yes to question one, that we should proceed with looking at trying to remove this condition for the classification based off of the SAC. The subjective nature of that, and then the fact that as we learn more, it's not very enforceable and doesn't have a lot of meaning on the actual collection of the debt seems unusual that it should therefore change the actual classification of the resulting debt. We had a lot of good discussion yesterday on the trigger comment. I think it would be helpful, pause. Maybe we should look back to the paragraph 30 definition. The additional funds, again, might not actually make the debt callable. But we should also explore potential guidance or different scenarios of what a demand letter might look like. We learned from the lenders in the room that there's a number of different documents that might get sent, a reservation of rights, which actually also wouldn't be a true demand note. So potential research on what that could look like. And it's a big arena, so maybe it's something that we can't do, but if there's any opportunity to provide some examples of what is a demand and what is something else, that would help.
Thank you. Doug?
Yeah, I think Adam said a lot of my comments really well, so I won't belabor the point, but just to have my vote out there, I vote yes for the removal of the probability assessment. I think just the inherent nature of a subjective acceleration clause, it is inherently very subjective. And so to assess probability in practice is difficult. It puts a lot of pressure on preparers and practitioners alike to audit that assessment. And again, when you talk about enforceability of that, from the lender perspective, we had a lot of great discussion yesterday. And so I certainly think there's a lot of basis to remove that assessment. I would also agree with the triggered discussion. I think what's interesting though, and I agree with Adam's points on exploring what those triggers may look like. And I don't know if that means we need to do more lender outreach, but this particular sentence stands out to me. So it says, in paragraph 42, a subjective acceleration clause is triggered when a borrower is notified by the lender of non-compliance, comma, including notification that occurs when there's a demand for payment or denies access to funds in an existing loan agreement. And so, I'm a little bit of an English buff on the side. And that comma to me is like, so first you get the notification that you're not in compliance, right? And then it's like, that could then trigger either a demand payment, which I think we all agree, if the lender's saying you're non-compliant and there's a need for payment today, that would be, okay, there's certainly a basis at that point for current classification. I would agree on the surface, a denial of access to funds under an existing agreement wouldn't necessarily be something that would trigger current classification, but like, I think there's just an inherent nature that there's probably more under the surface than just the denial of access to funds. So I don't know if that comma being like, there's this just, you're generally not in compliance and there's these other factors that then could be explored by the lender. I think that's where we're all talking about, like, what are the forms of these letters of non-compliance and what are the things that would actually trigger the current classification versus others, to Brad's point, that may just be explanatory disclosures on the, qualifications of the non-compliance. So I think it's definitely an interesting topic to explore to make sure we're getting to the right decision.
Thanks, Doug. David Hoagland has a touchdown.
Yeah, I would just say real quickly, instead of just saying including, maybe it should say something like should include or must include a demand for, so I'm not sure what including really means in a technical sense, but if we were writing policy, right, it would say should or must include demand for repayment, right? Because talked about, a lot of times we might say you're out of compliance, but we've reserved our rights. That's not a demand for payment. So I think the two really need to come together, that you've got that second piece of that. And it's not just, I don't know what the word including would mean, but should or must or is a word we would, or may would be the wrong word probably, but must, right? So we do a lot of that in policy, that we try to be a little bit more specific about those words.
Yeah, I think I agree with everything that's being said, because in my experience, there's typically two steps to this. One is notice of default and intent to accelerate. In other words, I have this clause. I don't like what's happening. I don't like what you've done. And if it's not fixed, I'm going to accelerate. I would not think that notice would require the debt to be classified as current. But if the key word that starts with an A is used, if it's accelerated, it's due. And then it has to be classified as current, in my opinion.
Thanks, Robert. Holly?
Yeah, I was kind of going down that same path, but I agree. I wanted to say that I agree with both 1 and 3 that, yeah, to remove the probability, and if it is triggered, to classify as current. I think I was going to add some comments on this whole trigger. I mean, is it as simple, instead of saying a letter of non-compliance, it's a letter that's that is demanding payment? Because I think that's where it gets a little confusing, because you can get a letter of non-compliance, but it doesn't necessarily, that's kind of what we heard, require payment. So maybe the trigger is that you're getting a letter demanding payment, which probably isn't going to happen very often, but I think that's okay.
Thanks, Holly. Rich?
Yeah, just a couple things maybe for the PCC to consider. It's been a long time since I looked at a auditor's cash and debt confirmations, but one thing you might want to think about is what wording would you put in that? Auditors and bankers, would you be able to sign it? Because effectively, that's the audit evidence you're going to get. You're not just going to rely on the company saying they didn't get it. You're going to send a confirmation to the borrower, to the lender. And so what are you going to say? The other item I would mention is consider cross defaults. So this last discussion you just had about notice of non-compliance, I'd be interested, do you think that triggers cross defaults on other debt? And if you do, how do you feel about treating that other debt as being in default, but this debt as not being in default? Just a couple additional considerations.
Thanks for that. Robert, or you've got Mike?
Yeah, just to answer the question, preliminary basis, right? No surprise, I definitely support removing the probability assessment. I do think anything is better than what we have today, because I don't know how we assess probability, and I don't know why we make it such a big deal in terms of classification when they're rarely enforced. I guess as I'm going through this, I think the trigger basis makes sense. Obviously, we need to do more research, but maybe distinguishing between the ability to refinance versus I have term debt and now a SAC provision is triggered. I think for a term loan, it has to be enforced. It's not a reservation of rights or a notice that we may call the debt. I think if it's triggered and they demand repayment, forget the additional funding for the term debt that's existing out there or debt that's long-term in nature now, I think that could trigger maybe current classification. With respect to cross defaults, not thought about it until you asked that question. I don't think it should trigger cross defaults because that's probably a legal assessment, but that's my preliminary feelings on it.
Robert?
I think the question of cross default deserves a lot of thought and consideration, because obviously if there's an acceleration, that means there's a default and something's going on. And the lender or other lenders could have the option to declare all the debt due. I don't know, that even could follow down the path of ongoing concerns. So I don't know. That's an outstanding question that merits a lot of thought as we work through this.
David Hoagland?
Yeah, I'd agree on the cross default. It's a little bit of a slippery slope. Folks may not, every lender is going to have their discretion of ability to call that cross default, right? But I guess as an auditor, you're looking at, now probability, but I guess in the future state of, well, they certainly can call it and there's reason to call it, right? If they would know about it. And then obviously what you put in the financial statements would help, because who knows if the borrower's letting everyone else know they're in default of their existing agreement. So I agree, there's probably some, like Robert said, some work to do there to consider that piece of it.
Adam?
In terms of cross defaults, and maybe it's another question for the lender, some of the discussion yesterday was actually related to concerns, particularly with the reservation of rights letters. If they start triggering current classification based off of your noncompliance with the subjective acceleration clause. And what I heard was the lender saying they were really using that as a negotiating tactic and not wanting to trigger cross defaults and thinking it might be inappropriate sort of to cause panic. So I'd include that part of the consideration. I was trying to look at, to your point on confirmations. I don't, in my memory, remember getting a confirmation that was completed by a lender to sufficient detail to tell me anything about a subjective acceleration clause or really much in related to it.
But in your debt conference, you do ask the lender the open-ended question, right? Is the debt in default, right?
I don't think we do. I mean, but we're also not the auditing standards board, so it's really not our call.
Yeah, I don't,
And
and you
look
asked for terms, I'm pulling up some general kind of templates. I don't,
and look at your cash confirmation where it asks if there's any outstanding borrowings with that depository account, and does that have a carry on? I don't remember.
yeah, I think there are some open-ended questions, but even the way cash confirmations roll through third-party intermediaries now, I would say that that is an element of evidence. There's not a great degree of confidence that banks complete that.
So just if you were auditing it and the accounting was based upon it had been triggered or not, what audit evidence would you get other than a confirmation from a lender?
Sure. We certainly would start with the confirmation, hope that the lender would tell us they may or may not. But we read minutes. It usually shows up in minutes and other documentation received with the client. That alone, I would say, is not enough audit evidence. We'd have to perform a variety of procedures to try to look for completeness. It's hard looking for things that may or may not be there. But I would say that open field and a confirmation is dependent on whatever staff at the bank filled it out. And that wouldn't be the sole procedure for sure.
Christine?
Yeah, just in listening to the conversation yesterday and also today, it seems that the PCC members, for the most part, would feel more comfortable with, excuse me, a trigger that is very explicit, a demand for repayment in some form or another, and I would agree with that. But I would say that if you go down the cross default path, I don't know why you wouldn't also require a demand for repayment by the debtors for which the cross default happened. Because it does seem like you're going away from probability in the case of the SAC, but then in terms of the knock-on effects, going back to some kind of a probability assessment, unless there's something in that contract where, regardless of whether or not you get a demand for repayment, you got to write a check to the other creditors. So I would just, I don't know enough about these contracts to know, but I would watch the, not let probability kind of seep back in to the analysis.
Great, thanks for that. David Hoagland?
Yeah, Christine, I think you make a really good point there that it's going to be hard to look away, right? If you're an auditor, I have to believe, right, from, okay, so your bond indenture has a cross default, with anything over $10 million, right? And, or a cross acceleration, right? Because a lot of times it's not a default, it's an acceleration. So now your debt's been accelerated, but you're looking away from the bond covenants, that's another $100 million, whatever it might be. It's going to be hard to look away from that and not say that that's a problem, even though the bonds, they have they have to call their own default, right? You're not calling it for them, but making that debt current is probably the appropriate thing to do as you're thinking about that piece of it. And back, go ahead.
I was just going to say, though, I guess that's how probability gets in here, right? Because I would think that the same situation could arise if you've got a company that has a subjective acceleration clause. You know you're dealing with a bank that tends to be one that would execute on that. You're at the end of the year, you're looking at the financial statements going, this company's in big trouble. And I'm pretty sure as an auditor that they're going to exercise this. So, I think you either want to get on the probability horse and ride it or get off of it. But it's hard to ride it sometimes and not others when we're dealing with similar sorts of situations.
Well, and that's when we end up getting, could the bondholders get can you waive the covenant because our auditors won't give us a clean, right?
Yeah.
So that's, kind of the circle that we play in now, right?
Yeah.
Because people use the subjective piece of it and they're like, well, we don't want our debt current. Can you, do X, Y, and Z for us?
Right.
For sure. And then Adam, back to your point on reservation of rights. Yeah, that's just a tool because banks have been caught not reacting to perceived defaults. And so it's not an acceleration, it's not a default, but it's a, we know there could be a problem here. We're telling you so that it doesn't look like we've had some sort of, course of dealings with our customers. So it's more of a legal thing we don't necessarily want to call it all at all times, but if we don't say something, then people will say it's a course of dealings with us, and we may not have the ability in the future to look back and say, oh, well, you're in default. Well, you should have told us then. It's too late now.
I mean, I'm in agreement on most of it. In regards to the cross defaults, if they're in effect for information that existed as of the balance sheet date and either the termination, notification or demand for repayment occurred based on that information, it would seem like even though the other cross defaults haven't issued it, that would probably require current classification. I think part of it might fall under whether or not our question on 855 and the treatment under subsequent events should come into play in terms of it was information available on conditions basis at that point in time. They did not receive notification until subsequent. Therefore, they didn't issue the demand letter until subsequent to the year. Would that push it back to not out of probability considerations, but the fact that they were not technically in compliance as of that date, even though the demand letter was subsequent?
Thank you. Mike Chang.
Yeah, I guess this discussion is helping me understand that current guidance is definitely broken, because today you're supposed to always assess the likelihood and the probability. Otherwise, you can't get non-current classification. But to think about this a little further and with the cross default, I think it's a fantastic question because it's spurring a lot of thought in my head, and maybe it's a little controversial. I don't think when a SAC is or a subjective acceleration clause or a MAC is triggered, that means that they're in default. It just means that we're now classifying your debt as current, right? I don't think the standard says the auditor has assessed it and we think you're in default. I guess another potential alternative, this is where I think it's a little controversial, and I'm going to ask the lenders, what if it did not affect the classification of debt? So there is a trigger where you're demanding repayment and you think the material adverse clause is what you're calling out and you're demanding repayment, and it's more of a disclosure. Because I guess the issue that I have is even if we come up with some thoughts and ideas, it's subjective in nature. So if it's subjective in nature, I think we essentially become lawyers, which we're not. I mean, that's not what we're in play to do. I think that has to go through a vetting process to say, yeah, the SAC is enforceable or the MAC is enforceable. I don't know how we do that under the gun at the 11th hour to issue financials. So instead, if it did not affect the classification, but now you got a disclosure, the trigger is that you're demanded repayment and it's under a MAC provision.
So I mean, the genesis of our dialogue around these subjective clauses is that the auditor is forcing the company and their lender to jump through a lot of hoops and spend a lot of money and time, to do something that is potentially undoable. And us trying to figure out how we save companies money in making them, keeping them from having to go through those steps, I think is an important element of this dialogue. That because today we make them do it all the time, whether anything has really happened or not. And I know that's annoying to lenders, and our view of it is, hey, we're not attorneys, so you need to give us a letter so that we don't have to be attorneys. So I think that has to feed into the dialogue is this really something that requires the company ultimately, because the bank charges the company when they incur legal fees, right? So
yeah,
is this something that we can help preparers deal with in a more rational, timely manner, rather than it being this crisis that is created?
Yeah, and I think MACs and SACs are in our guidance because they provide information. It's decision useful. It's just I don't know if it requires us to change whether the debt is current or non-current. I think if we define a trigger point, now it's a disclosure, it's objective. This is what that is. And then you can make your own assessment of whether you want to dig in deeper. So.
Okay, David Pesh is going with the touchdown to bypass the process.
No, but to that point, as a user, take a step back and look at, a covenant violation with a waiver, right? So that's now disclosed in the financial statement, in the notes. And as a user, I have to then evaluate. So it comes down to that same thing. This really is not that much different than, hey, on December 31st, 2023, they were in violation of their covenants and we have a waiver from the bank. I'm getting that statement in June of 2024. And I'm going back now and I've got my decision useful information. And then I've got to go investigate, right? So again, to Michael's point, triggering disclosure is a pretty key part of this.
Well, because in your scenario, your types might not have classified balance sheets. So
Right.
the place that the debt is might be less relevant to you than what's going on with it.
Correct. And the other point I'll make, well, since my mic's on, cross default, that's a very slippery slope because you then are going to raise up. Do you have to look at cross default in every other aspect of their business, right? So if you have a material customer, 40% of your revenue comes from that customer, and you have contracts with that customer, and every one of them has cross default. Now, do you have to go and start investigating all your customer contracts in cross default? So I'm really not a proponent of going down the slippery slope of looking for cross default language, and that's just adding more time and money, not less.
David F.
On that though, if there's the potential that they triggered something that was in default, I think that information would be useful to users at that point though.
Yeah, now we're getting back to the trigger definition, right? Which I think is what this is leading to, is what's the trigger definition? What's the true, can we make it black and white? And again, demand for repayment is, in my mind, that's the trigger. Whether you enforce it or not doesn't matter, but for a user, if there's a demand for repayment and negotiations are ongoing and I didn't know about it until I got a financial statement and read the notes, that's a big deal. But any other type of negotiation with the lender that's ongoing in the background just because of a reservation of rights letter is not as big as a, hey, I demanded payment.
Rich?
Yeah, I know Christy made the point earlier on probability and being consistent. Maybe bring that back a bit. One of the challenges, and I definitely understand the PCC looking at this narrowly on max and sax. The problem is when you pull on that model and want to make that a balance sheet date assessment, none of the other debt classification is balance sheet date assessment. If you start thinking about waivers, they're delivered after year end. They're not delivered at the balance sheet date. If you think about the intent and ability to refinance, that's not necessarily a balance sheet date assessment. That's a post balance sheet date assessment. It might be worth it to step back and trust me, there's issues with if you just go to a balance sheet date assessment, right? Because that means you go to the client who didn't know they defaulted on their debt and you explain to them too late you didn't get your waiver at 12/31, or maybe you think it's okay if they got it after. But I think that's one of the challenges you're going to run into. Cross defaults as an example of it. And think about, would you be more comfortable if you just went to a straight balance sheet date assessment? It makes it easier. If you're really only looking for simplification, you could do that. There's some bad things that'll come with it and there's some good things, but it'll be simpler if it's solely a balance sheet date assessment. And is that really what you're trying to get to?
Thank you. Sue?
I was somewhat reacting to Michael Chang's comments about disclosure. And I was thinking, to the extent you get the trigger right, it seems like it should have an inherent consequence, right? If we get the trigger truly right, and in terms of balance sheet classification, But what I was thinking about in terms of disclosure, if it ended up being just disclosure only, it just seems to me like you're shifting some of the cost from the preparer and the auditor to the user of the financial statements to actually evaluate what that means. And it could be, to Dave Pesch's point, 3 or 4 or 5 months later, because they're not getting them as timely as they should. And so I just wondered about, to the extent we're able to get the trigger actually right, notwithstanding some of the comments that Rich just made about cutoff.
Yeah, I guess what I struggle with is if a SAC or a MAC gets triggered and they demand repayment, I don't know if it necessarily means that that's going to happen. So this is only going to be for existing debt that otherwise would be classified as non-current. Lender asks for money because of a MAC clause, and the borrower is like, well, that's great that you asked for it, but I'm not going to pay you. And we're going to have to go through court to figure that out. I think there's scenarios in which they could win and there's scenarios in which they could lose. But when we're trying to issue the financial statements at that point in time, that's very difficult to assess. But we're making the call, hey, just because the lender asked for it and it is subjective, we're going to now say this debt is due and current. They're asking for it, but I think it's different if it actually happens. And then with the proposal of the balance sheet, as of the balance sheet date assessment, I think that's a beautiful project. It makes a lot of sense. There's no other area of gap where you would apply events that occur after the balance sheet date to, as of the balance sheet date. So I get all of the arguments for it, and it's very simple. But I think we've tried several times, more than once, and it's met with heavy, significant resistance. I think so. I mean, I just warn, if we do, it makes all the sense in the world. Just in reality, if you go ask the TIC, they've got, I think, several letters that would argue against that approach, just as a warning.
Just for the record, we did just put out a standard that allows receivables collected after the year end to be counted. So it's not exactly true, at least as far as we're concerned. Christine?
So I agree with Michael. That is a beautiful project. And in fact, it's what we exposed in 2019. And at the time, I very much wanted that project to see the end of the road and to get accepted, because the principle was a balance sheet date assessment based on contractual obligations that exist and contractual rights that exist as of the balance sheet date. But I do recall conversations with the PCC at the time, because that balance sheet date assessment cuts both ways, which means if you've got something that's currently current, but you have the intent and ability, well, you can't, it doesn't matter anymore. It's current. And there was more concern about stuff that's current not being able to be classified as non-current than there was a desire to deal with the problem of stuff that maybe really should be non-current getting classified as current under the probability assessment. So I think, to Michael's point, we've been down this path and just weren't successful before.
Thank you. Hillary?
I think Christine took most of my talking points with regards to this, but I certainly think that looking at things on more of an individual basis of, SACs and MACs versus waiver covenant, covenant waivers versus refinancing, I think it's, at least from my perspective, worth it to do the work with regards to the SACs and MACs. These are terms that are in every agreement. I think we've heard they're not often called. I think what I've heard today in the discussion is making sure that, sounds like to me, the trigger is a pretty high hurdle, that people want it to be a high hurdle. They want it to be very clear, they want it to be objective, and they want it to be auditable, right? And there's work that's going to go into that, but that certainly seems like something that, at least from my perspective, sounds doable. And, I do think incremental improvement in this area is something that would be welcomed by, all stakeholders. And certainly I take Rich's point, and I agree that, that'd be a great project, but I maybe don't have quite as much confidence that that's something we're going to be able to get through and get some of that relief to all different stakeholders with this issue. So
Thank you. So I'm going to observe that we're like 1/3 of the way through this memo and we're almost to the end of our time. So, if you have something that you think is unique to the dialogue that will help inform the staff, that would be great. David H.
There was I was going to respond to Mike and maybe Sue about the penalty is significant whether you bring it current or not, because as soon as you disclose this, like the bells are going off for every lender. Just ask, someone who's doing it, right? So the penalties are huge, and I guess, and I'll put my mic off, but Mike said, doesn't matter if it goes current. Doesn't matter to me if it goes current. If I've got to disclosure, then that's enough to give me the information I need. But there might be some models that Dave Pesch uses for current versus longer term liabilities that throw something out of whack in his model that might bring him to the table in a covenant compliance or something like that. So that could be a hammer as well.
Oh, yeah.
I'll let the banker go next.
Yeah. I gotta say, I think the demand for payment's a bright line. And I don't think you can be in the role of saying, well, they've demanded, but it might not be. I think it's better to fail safe and say, this company's got a demand on this note and it's now due. It may be sorted out later differently, but I think, to me, I really like the idea of a bright line along a demand for payment.
Mike?
Sue.
Maybe I'm just, I was thinking in my mind that the trigger, if it's so very well defined that you've demanded repayment, I guess maybe a question for you is, how often do you actually issue those letters versus a reservation of rights? So if you have the trigger really well defined and it's when you demand repayment, and my understanding is you hardly ever issue those, so then it would ever hit the trigger, right? Okay. For the audience, he said yes, he agreed with me.
Yeah, I'll be quick on this. The reason I don't want it to trigger current classification is if you've got debt covenants that is pegged to your current ratio or something, right, related to current or non-current, and we haven't figured out whether that debt is due based on that demand letter. I don't know if I want it to affect all the other covenants, I guess, is my reservation. And to move ahead, I have a difference in opinion if it's the intent and ability to refinance and the lender is not providing more funding. So just as a preview, I do have a difference. This is that's currently non-current. That's really poor language. It's debt that's non-current right now, right? And you've gotten this MAC exerciser trigger. So that's different to me than a revolver or something that is short-term in nature, and now you're assessing the ability to refinance. I think for me, that's very different.
Well, that's a great segue to our next two sections. First, the intent and ability to refinance.
Thank you. Try to make this tee up quick. So the next area is intent and ability to refinance short-term debt on a long-term basis. And as we've been talking about, the guidance precludes non-current classification of short-term debt that is intended to be refinanced after the balance sheet date when that refinancing agreement includes a subjective acceleration clause. We identified two potential alternatives in paragraph 56 of your memo. Alternative A would amend the conditions such that it would be met unless a subjective acceleration clause has been triggered. Therefore, the mere existence of such a clause would no longer automatically result in a failed condition. Alternative B is to retain current guidance. So with that, we want to get feedback from PCC members on questions 4 through 7. 4, we're asking users, how common is it for private company refinancing agreements to include subjective acceleration clauses? Question 5, do you want to address that condition in paragraph 470-1045-14B1? And then question 6, ask whether the condition should be amended such that a subjective acceleration clause would affect debt only when it's triggered. And then do you think additional outreach is needed? And if so, with whom?
David Hoagland.
There's a lot there, but I'll tell you what I picked up out of it. Number one is refinance. back in the day, there used to be, oh, you get a commitment letter, it's 30 pages and you commit to it. No one really does that anymore, probably because of max clauses and not wanting the world to change between now and the date we close. So typically, the day we close is the day we're committed to it. So I'm not sure there's a refinance scenario in place. Exceptions to that, because there's always exceptions, is kind of like a delayed draw term loan, right? For instance, it'll have its own clauses in it, right? So you're going to be able to review that. It's already signed up and it's ready to go, right? So there are some examples out there, and they're probably in the private and public markets, but I probably see them more in the public markets where, you're going to be able to evaluate that based on that agreement. But there's not a lot of, in a refinance scenario, there's not a lot of, hey, we closed the loan and we've agreed to everything, so you can look at this. You would be looking at a draft at best for a refinance. So not sure where that necessarily leaves us for that question, right? It just isn't really practical today, except in conditions where it's already been agreed to. But I think this is where a lot of these things came into effect when you're doing an M&A transaction and you need committed financing, right? Mostly in the public market, but sometimes you're going private, where if the world changes, you want the ability to pull that financing away. And usually it's in a commitment letter or something like that, versus a loan agreement that, so I think you're, I guess, going to be able to evaluate it. But at the same time, you'd want someone to have called that to say that they're not going to provide the financing.
So your point is that the ability to refinance is much more narrow than it used to be, because people don't give you commitment letters anymore. They give you funding.
That's it.
Michael Chang?
Yeah, so I'm probably going to sound like I'm backtracking, but I'm not. I think the intent and ability to refinance model it's different than what we were just talking about, right? What we were talking about earlier was I have debt, it's non-current, and whether I should change that. If you fall into the intent and ability to refinance, I think if you get a letter that says I'm enforcing a MAC provision and I'm no longer going to give you money or additional funding, I do think that should affect the classification of your debt, meaning it should move things to current, because I think you've just said my ability to refinance is now in question. I think that's essentially black and white for at least that specific debt agreement. So that's where I do think it should affect it. I think the assessment's different. But to answer your questions, yes, I think we should consider the inclusion of a MAC or a SAC in a commitment to finance. I think it should be trigger based, and I don't think automatically having one should trigger debt as being current. I think it should be when it happens. And I do think for this, it should affect the classification. Anything that falls under that model, which is different than what I said earlier, but I'm not being hypocritical here. Just make sure that everybody understands my distinction.
Yeah, I think intent and ability to refinance is kind of again, I'll use the term because it's going on a slippery slope, right? The ability to refinance changes every day with changes in the credit market. So how is an accountant going to assess the ability of any firm to refinance any debt at any point in time? So I'm still of the opinion, and again, the word keeps coming up, a very black and white trigger. This happens, it's current. This hasn't happened, it's still long term, and we move on from there. But it's tough.
Robert, Mess?
I have lived my entire life in the gap between intent and ability.
That's pretty hard to follow up on. As a practitioner, I mean, we tend to lean a little bit more towards now a little bit more risk adverse in terms of those considerations. So both to your points, the intent and ability, we really don't consider that in a lot of instances until you actually have a signed agreement in hand, in which we may hold the financials until we actually get a signed thing. So it seems like that's not really something, as a practitioner, we really even lean on.
Michael?
So David, I think your comments resonated with me in the sense that this doesn't really happen anymore, but I think it has downstream impact because the revolver with a lockbox model hinges on the intent and ability to refinance, right? You got a revolver that's essentially current, but your ability to refinance that has a SAC provision, that's where I'm trying to ultimately get to, because I think this model still provides relevance. It's just not in the format that we apply it today. It's kind of downstream later.
Okay, thanks, Mike. That leads us nicely into the next topic of revolving credit agreements. Topic 470 also provides guidance on debt classification of revolving credit agreements with features such as lockbox arrangements or springing lockbox arrangements and subjective acceleration clauses. And this guidance intersects with both the probability assessment guidance and the intent and ability to refinance guidance. In June, the PCC noted that this guidance is often overlooked and incorrectly applied. The memo discussed potential paths depending on how the PCC addresses both the probability assessment and intent and ability to refinance guidance. In yesterday's session with TIC, they agreed that any changes made to these areas should be made consistently throughout other places in the guidance. And with that, we would like to get feedback on questions 8 through 12. These ask whether the PCC thinks conforming changes should be made to the guidance in paragraphs 470-10-45-4 through 45-6, and whether additional outreach is needed, and if so, with who.
I do think we should look at this area to make conforming changes for all the same reasons. My understanding of how the SACs and MACs operate, I don't think those, the mere existence of those alone should be changing the classification.
David? H?
Yeah, I'm not as Jerry said yesterday that, I'm specialized in commercial real estate, so ours isn't about classification of debt and those things. But as I think about how you might do this, I don't think it's about getting a notification. Maybe there's some notification there, but really is it, if you've got a revolving credit agreement that, let's say, has, receivables or some other sort of type of cash flows that all of a sudden get trapped in a lockbox and go through the waterfall, seems like it's pretty obvious that this is now current, right? And so I think in my mind, and I haven't explored it much, right? Because it's not my area of expertise, but I feel like, I do cover the asset back side. And so if we're in situation where companies, has that material adverse effect or whatever it might be, we're pushing the cash flow through the waterfall. And so maybe it's a different test versus us, sending them a letter that would default it and demand immediate payment, because then the bondholders are at the table. And so I think it's a different, maybe it's a different assessment if you've got what I'd call it a cash trap or some thoughts.
Adam?
So I guess follow-up question to make sure I'm thinking about this right. If there's the springing lockbox, would it be normal to trigger the springing lockbox and pull the cash proceeds because of a subjective acceleration clause alone?
I suspect that if we were to see something material adverse in the business, right? We would probably we would be looking at that clause, and we would go, and if we think of springing lockbox like, I guess you're thinking it's already set up, but yet we're now pushing the cash flow through it, right? And so I'll use that definition versus a lot of times you just wait to set it up until something bad happens. So it's already been set up, it's springing, And so instead of, so it starts going through the waterfall.
Well,
Yeah, I would
and-
say, that would,
Yeah,
that's
so
our
springing,
collateral, right?
springing cash goes in the general bank account.
Yeah.
But in this scenario, okay, we're going to trigger the SAC. So now we're going to flow the cash to pay off the debt and set them into your general banking account. And I mean, I guess that's the core of the issue. Is that practical? Is that really going to happen without going to court?
Yeah.
Can
we're
you just say,
if it's a collateral situation, let's say next week you're going to file bankruptcy, right? Then yeah, we're going to get as much cash as we can, and you're either going to have to, because that's the operation of that revolving credit agreement, particularly like in the asset-backed world, right, where you actually can control those cash flows. That's one of the operational aspects, and that's why I say it's a little bit different versus a lot of letters being sent out and defaults to make that happen. We can make that happen as a part of operations, and it can be contested, obviously, and you've got to go, you ultimately, there'll be a stay when the bankruptcy happens because now you're taking all their cash flow. But that's why I think it's just a little bit of a different operational piece when you control the cash flow of the company. It's not really in a real estate deal, but if someone's an ABF borrower and that's their only lifeline is that everything, all their collaterals in a asset-backed financing, right? Then it's really, if a cash trap is affected, then that could be a pretty bright line trigger in terms of how to think about, bringing that current, I would think.
So it goes, the bank becomes in control.
Yeah.
So I think when the bank's in control, the debt's current. That'd be my own. I think that stops being a subjective element and starts being an objective one.
but I guess the question is, when does the existence of the subjective clause mean the bank is always in control? Maybe we need more outreach and more insight from some banks on this.
But see, I think that's an event where the bank has taken specific objective action. Whether you agree that they can do it or not, that's different. But they've taken specific objective action. And I think from a preparer and an auditor standpoint, I don't need to make any sort of value proposition about whether they're going to win or lose. They did it. And
Yeah, I'm not asking if when they did it, I mean, obviously they take the cash.
You're
that's
saying the
I'm
existence
saying,
of
does
it.
the existence of the clause in the agreement, should the mere fact that that clause exists, should that dictate the classification, is, I guess, where my head's at.
Robert?
I think the real issue here is which side are we going to fall safe on? Are we going to fall safe on waving the flag if we think there could be something that users need to know about that would preclude them from being harmed in the future? Or are we going to fall safe on the side of saying issuing this could cause the company to be damaged and have more expense? Of course, as a user, we want you to fall on our side. And if we think that there's an opportunity that this is going to be a big deal, we want the liabilities classified current and we want the flag waved. But I do understand that if you do that, it could have some very negative implications for the company.
Thank you. Holly?
I guess my comments are, I do think the language should be consistent for moving down this path with revolving credit agreements. The thing I wanted to add that came up in our conversation with Tick yesterday is in the situation, because we've been talking about demands for repayment, but if we get in a situation where the access to the revolver for additional financing gets eliminated or closed off, that doesn't necessarily mean that the outstanding debt under the revolving credit agreement would be accelerated. I think that's an important point that we have to take into account that came up from Tick yesterday.
So we've talked about this issue a lot in the last 24 hours, both at Tick and here. And I know people have some other comments, but I think what we know for sure is we want the FASB staff to do more. I think outreach with some lenders about this springing lockbox concept is relevant. What conditions do they choose to use those versus others? And so maybe some more questions offline between the PCC and the FASB staff might happen as they start embarking on this new sort of round of research related to this. And we'll evaluate, if we're going to be prepared to talk about this again in December, but we clearly will be talking about this again in the future. Mike, any last comments?
Yeah, because I'm gonna be quick. So I do think revolvers are under the intent and ability to refinance, but just to be, I don't think the language should be consistent from what we were talking about before. So when we initially started this discussion, it should be triggered base, but I think it's for non-current debt, if it's triggered and it's demanding repayment, I don't think that should change classification. I think that language, that triggering language, should be different when you're talking about a revolver with a lockbox arrangement. Because a revolver with a lockbox arrangement means that the debt is current, but what you're hanging your hat on is the ability to refinance. So if they've triggered a MAC provision and said, I'm not going to provide you additional financing, or I think, I'm enforcing the MAC clause, I'm okay with the repayment request or failure to provide financing. And from that standpoint, I also think it should affect classification because your ability to refinance with your current lender is in question. So
thanks for that. And what a great dialogue. Thank you guys for that. And Chris, you're walking into a very excited crowd to talk about interest method.
Morning. Thanks, Jerry. As a reminder, during the June PCC meeting, we summarized overall feedback on challenges applying the interest method in practice and potential ways to address those challenges. Specifically, the PCC discussed an alternative to the interest method that would use the contractual interest rate in the loan as a starting point in the interest expense calculation, and then would subject any premium or discount, including those arising from debt issuance costs, to straight line amortization. During that meeting, the PCC requested that the staff research the scope of a potential alternative, provide additional examples in which there could be a significant discount, and research potential tax accounting implications. Since then, the staff has conducted outreach with 6 practitioner firms on these areas and has also discussed some of these issues with the AICPA's Technical Issues Committee. Today, I'll be providing an update on the staff's research. Our session will be organized into 3 areas, each of which I'm going to tee up separately. So we'll take a short pause before we move on to each section. And those sections will be scope, interaction with the guidance will be the first section. Second section would be interaction with the guidance in subtopic 470.50 on debt modifications and subtopic 470.60 on TDRs. And then the final one would be special debt accounting models, income taxes, and next steps. Our questions for the PCC on each section are similar to those we pose in outreach. That is, we have some factual questions to understand the types of debt instruments and fact patterns that PCC members have observed in practice. And we also have questions designed to understand PCC members' preliminary views. But starting with scope, our meeting materials illustrate that when there's a significant discount or premium, the results under the interest method and the potential alternative could be potentially very different. We note that discounts or premiums could arise to debt proceeds being allocated to multiple units of account, or due to initial measurement at fair value, such as following a business combination. During the June meeting, PCC members indicated that such scenarios might be addressed by considering a scope exception that restricts the potential private company alternative to simpler debt instruments, and reference the guidance on plain vanilla swaps in topic 815 on derivatives and hedging. One PCC member also observed that these simpler debt instruments might be more common than some of the more complex instruments that exist in practice. That discussion influenced how we developed potential approaches that we discussed in outreach and have included in this question too. That is, we developed some specific scope exceptions that would try to limit the potential alternative explicitly to simple debt instruments. And we also developed a few broad exceptions, one based on the phrase substantial premium or discount from the derivatives guidance, and another based on a 10% bright line. Before I jump into the feedback on these scoping approaches, though, a quick note on the overall sentiment that was shared in outreach. We noted that about half of the practitioners we discussed this issue with indicated that they disagreed with the overall research direction related to developing an alternative to the interest method. Those practitioners, which varied in size, indicated that this is not necessarily a significant issue in practice, and that, if anything, this represents an area where the development of educational materials might be a better approach. By contrast, others provided feedback ranging from neutral to supportive of the PCC's research in this area. As far as the feedback received specific to the scoping issue, practitioners generally identify debt issued with detachable warrants as the most common source of significant differences between the effective rate and the contractual rate. Therefore, those would be the instruments whose accounting we expect to be most affected under a potential private company alternative. For example, some noted that warrants tend to create discounts in the 10 to 15% range, while others noted that they somewhat frequently create discounts in the 30 to 50% range. While practitioners acknowledge that bifurcated derivatives and initial measurement at fair value can also create premiums or discounts, they noted that detachable warrants did so more commonly than either of those accounting models. As far as whether the scope of a potential alternative should be limited, we received mixed feedback on that point. Some agreed that to reduce the impact on financial reporting, there should be a limitation on which instruments the potential private company alternative should be allowed to be applied to. But it's notable that others were not supportive of scope exceptions in general for a variety of reasons. Some thought that any scope exception would add to the complexity of a potential scope exception and might offset any of the benefits of providing for the alternative. One that did not support the research in general expressed skepticism that an operable scope could be developed. As far as what form the scope exceptions could take, in outreach, there was little support for any of the specific scope exceptions. In contrast, there was some support for a broad exception, with some indicating that the phrase substantial premium or discount could potentially be applied without needing significant clarifications. However, some indicated that clarifications would be needed for that phrase, and given that feedback, we also began asking practitioners about a potential 10% bright line. However, even on the bright line, we received mixed feedback on that approach as well. So with that, I'll pass it off to the PCC to discuss questions 1 through 3. Again, the first question is a fact-finding question about PCC members' experience and practice, while questions 2 and 3 are seeking PCC members' preliminary views about whether to limit the scope of a potential alternative, and if so, what kind of approach we should be targeting. That is, one of the specific exceptions or one of the broader exceptions.
Thanks for that, Chris. And as many said yesterday, this was a very much appreciated documentation that you and the rest of the staff pulled together. So thank you guys for that. David Finkelstein.
Just in regards to your questions on the allocation proceeds, the first one, we do see discounts from that. Our average ranges seem to be about 15 to 25%. On rare occasions, we have seen almost 100% discounts. Usually it's something that a lot of warrants or something are issued along with it, and they don't consider it to have value. But when you do an actual, financial model value, it exceeds potentially the value of the debt. In regards to what we've seen on business combinations, a lot of the debt that we end up seeing, most of them end up being financed or extinguished as part of the transaction. A lot of them have redemption clauses in them that upon a fundamental transaction, they seem to require repayment. So we don't see a lot of them being revalued, except for maybe smaller ones, which may have an immaterial impact, like a small vehicle or equipment loan that may not be significant.
Thanks, David. Michael Chang.
Yeah, memo was fantastic. I learned a lot about interest, and it opened up my eyes, I think, on certain issues. So bravo to the work here. But to answer your questions, I see debt discounts, rarely premiums, being created along the spectrum of warrants and then embedded derivatives. So you've got a debt instrument with share settlement features, which is what I most commonly see. So I think the feedback on where we see it is pretty consistent with what you had in the memo. I think the one thing that I guess our practice sees a difference in is business combinations. So it's not the actual business where you have a liability that gets assumed, where you're doing the fair value. In our space, we see a lot of seller financing. So the seller is trying to sell their business and our private company is trying to buy it. And a lot of times they'll say, well, we'll buy your company. We can't give you all the cash. We'll offer you 5%. right? It's uncollateralized, and at 5%, I mean, a lot of our teams kind of miss it in terms of a fair value basis. My first question that I asked them is, would you loan money to this company without collateral at 5% when you go to the government and pretty much get that? And they immediately realize, okay, this is off, market. So I think discounts get created there, or just the fact that you have fixed payments over a long period of time. So I do see it a lot in either acquisitions or business combinations in our market. With respect to your scope exceptions, I agree. I think if we are going to pursue this project, we'd have to keep it fairly broad and not complex. If you can calculate whether something is substantial or you're trying to create some bright line, I think you already know how to do the effective interest rate method. So it kind of is counterintuitive. So my proposal would be to keep it broad. I think I could at least restrain it to, you go ahead and apply this, but if you've got any debt that has a requirement to bifurcate embedded derivatives, you get kicked out. Because I think if you got yourself into that, then you're probably going to get into a lot more complicated accounting, which, by the way, if you've got debt with bifurcated embedded derivatives, you could just fair value that entire thing and make your life a lot easier. You're going to have to do some type of fair valuing, so I have less sympathy there. And in terms of further research, I think the research would be dependent on how users feel about interest expense and whether straight lining or what they see in this memo gives them pause or concern, but that's really where it would be. I think I have enough information in terms of the debits and credits, the theory. It's kind of what users feel about it.
Thanks, Mike. Doug?
Mike took a lot of my steam there, but maybe before I address the specific questions, allow me to take a step back for us for a second and just talk about what we were seeking, I think, as a PCC to achieve with this particular topic. I think the straight lining of interest, and it's interesting, even there was some dialogue between even us and the staff on what we meant when we said straight lining. Is it an intent to straight line all interest in an arrangement, meaning ignore the contractual interest rate and just straight line the whole arrangement? And we finally got to the point where no, I think the proposal, and I think the staff did a great job in this memo, was you would follow the contractual interest in the agreement, and then any discount, premium, debt issuance costs that would be created would be what was straight lined. And so why would we want to pursue that? I think as a preparer and a previous practitioner, it has been my experience that people just do not follow the effective interest method for amortizing discounts, premiums, and debt issuance costs. It's almost become standard practice to straight line them. And that's just the reality. And I think what's interesting to me, and not to say that, I fully disagree with the practitioner feedback that was addressed in the memo of, we don't think this is high priority or even important. I would tend to then argue, I think it's a lot more pervasive than reality. And I know the presumption is that it's not material. I question how often audit firms are really auditing that material difference between straight line and effective. How even aware are they that their clients are using straight line in all circumstances? And so not to say that I think this project is simply codifying existing practice, but I do think from that matter of fact, it is pervasive. I think it's happening a lot. I don't think preparers are really doing the full evaluation of materiality. And so I think this is an opportunity to create some true simplification in a sense that, at least if it's already happening now, it's an allowable approach. So that's a little bit of the step back on sort of why I think this is an important potential simplification. Now, to start to address some of the specific questions, and I will also reiterate Mike's point, and I said this yesterday, Chris, I opened this memo and it was 38 pages, and I was like, how in the world do we write 38 pages on straight lining of interest? And I thought the memo was just extremely well done. I think it laid the issues out really well. I think a lot of the basis for those of us that were really supportive of this straight line approach was that from a user relevance perspective, it wouldn't change decision making. And I think Mike's final comment on how are we thinking about interest expense, because if you're straight lining or effective interest, you're really just talking about the timing of interest. And I think for those of us that look at EBITDA as a driving metric for private companies, it doesn't impact EBITDA. So it's kind of a sort of neutral issue on whether I straight line or I apply effective interest. I think what the memo did a good job of sort of highlighting when you think about PCDMF and you think about user relevance is for amortizing debt, if I straight line versus if I use effective interest, it will change the allocation of my fixed interest payments between interest expense and principal. What does that mean? That does have an impact on your operating cash flows. It has an impact on your financing cash flows. I think about free cash flow as a significant metric for a lot of companies. If you're changing operating cash, you're changing your free cash flow metric. So I think the crux of this, before we even start getting into scope exceptions and whether we should have them or whether we should not have them, I think there needs to be a foundational understanding of like, what is the user relevance here? And are we all in agreement and alignment on, I think for many of us who kind of went into this project with, no one's making it, if I'm a banker, I'm looking at cash interest anyway, like how my client puts the gap interest expense on their income statement isn't going to change how I evaluate their financials. You know, if that's truly where we're sitting, then I think we should go with a broad approach to this. I think you start adding a bunch of scope exceptions and you start creating a bunch of noise and a bunch of undue complexity. And I would argue you've achieved none of the simplifications that we sought to do in this. However, if all of a sudden we do think there is a materiality play with the interest expense, people do care, it is much more relevant. Now, I do think we have to start looking at some of these scope exceptions. I think the specific scope exceptions have too many potential flaws. I think if you say, well, if it's got an embedded feature, you kick out. Well, what if the embedded feature is immaterial? You know, I think there's embedded features a lot of times, especially for, you know, I don't see it a ton, but I did some outreach, and it's very common for private companies to have debt arrangements with other features in there. And so I think sometimes they're material and sometimes they're not. So I would, from my opinion, say, I would tend to go away from those specific scope exceptions and now start to lead more towards those broad exceptions. The issue with the broad exceptions now is that you're having to do all of these calculations that, again, if the end goal here is to create simplification. Now, the one that was interesting to me, and I think you guys did a good job of highlighting it, paragraph 90 and 91, the sale of future revenue, where it was just like a zero interest loan, basically. I think the bright line test there of saying, hey, if you take the total discount or premium and you look at that as a percentage of the total undiscounted payments and it's over under a certain percentage, that doesn't require any crazy calculations for the most part. You do have to have a general, you have to know what the effective interest rate is to understand what the carrying value of the loan is. So there's a little bit of calculation, but I could see that being doable. So if I were to say any of the scope exceptions, maybe more of that bright line percentage, it gives clarity. I still think there's flaws. I think that takes away some of the simplification, but I'm more supportive of that approach than maybe these more like, hey, if you fall under fair value of debt, it's got an embedded feature, you automatically kick out. I don't love that. So I will end my comments with, I think the foundational question we have here is, and I know we're going to get to a future topic on this about the interplay with the debt modification guidance. And I think I used the term the chicken and the egg yesterday. Whatever we touch here is going to have impacts on the debt mod guidance. And so I think we're going to have to somehow address that too. But I think we come back to user relevance and how are decisions being impacted or not impacted based on the gap recording of interest expense, when my argument would be cash interest is what most people care about anyway. And that's what they're looking at. And so from my vantage point, I don't think it's as relevant. But if there's a foundational disagreement there, then I think that's going to impact the direction we take on any of these potential approaches. So
Thanks, Doug. I will also note that Doug did not say to eat more chicken in that comment, though he was accused of that, I think, yesterday. Christine?
So standard setting is expensive. There's a lot of resources that have to get consumed in creating accounting standards, all the outreach. It's expensive for the FASB, but it's also expensive for stakeholders. And so if the outcome of a project is that it's going to significantly change practice or result in additional decision useful information for investors, that's a good reason to invest those resources. But I get a little nervous when we talk about, well, this shouldn't change practice because entities have already figured it out. And they're straight lining when, on a regular basis anyway. That to me is the definition of generally accepted accounting principles. I mean, they're already doing what is considered generally accepted in the marketplace. And investors don't seem to be unhappy with the information they're getting. So I know Doug, you said this project would not just codify existing practice, but then you went on to describe it in a way that sounded a lot like it was going to be codifying existing practice. And so I think that is an important question to ask. Like, to what extent is this actually going to change what is done in the market and the information that investors will be getting? And if the answer is that it's a very marginal change, I think that, educational materials might be a way to go, but to me, it would be hard to make that cost benefit argument.
Thanks, Christine. Holly?
I was basically going to support Doug's comments about, codifying existing practice, and I'm kind of keep it simple, no scope exceptions.
Katina?
I do think we find ourselves in a position where we either have a significant discount, right, where it's quite material, and in those cases, I think that both preparers and practitioners are taking a look at that and are aware of the amortization and the effective interest method. Or I think we're in a situation where your debt issuance costs or whatever you might be amortizing might be so immaterial that they may not even be in scope at all. So I don't know. While I do agree that in practice, when it's not material, you probably do have a lot of folks that are straight lining. I don't know if it's so important to continue the efforts here.
Thanks for that. Can I ask, thanks, Adam, but can I ask the users what you guys think? David Pesh?
Yeah, I think the users are remaining silent because of a point Doug made, which is, look, I'm looking at the cash interest. All the rest of this is really not that decision useful in my day-to-day life. So I mean, I'm on the side of, maybe just do what you need to do to make what's in practice codified, but it's not going to change anything that I do, no matter what path you go on this. So I'm not sure this is, really that relevant to me day to day.
Robert?
Echo those comments. It's cash, and at the end of the maturity, the balance is going to be zero. The path that it's taken to get there is not a huge difference to me.
Yeah, I'd agree with all that. I'd say the debt piece is the most important, so we're digging in to see what they're actually paying and, whatever material or immaterial, what the fees were up front and how you're amortizing it, what's going on the balance sheet. That's just not really a consideration. We're just looking for future coverage.
Rich?
Just for the users, do you feel the same way about zero coupon bonds? Just curious. We have a lot of interest expense and there's no cash.
I'm sorry, I didn't hear the last part of the question.
We have a lot of interest expense over the term of a zero coupon bond, and the cash only goes at the end. Do you feel the same way about that?
I look at the cash and how much cash did you receive, and then how much total cash are you going to have to pay back over the life of the obligation?
I'll take that as an endorsement of our required disclosure in the statement of cash flows of cash interest paid. Does it? Okay.
Mike Chang?
I'm probably jumping ahead, but I didn't know when to make the statement. So I do think this project, just to give background, my focus has all along been debt modification, right? So when you amend your debt or you have, how do you do the accounting there? And I think that that's super complex. I would probably say I'm one of the champions or the annoying members that have raised the simplified interest rate method, because I thought no matter what we're going to do, you're going to encounter this issue. Because if you modify your debt or extinguish your debt, it's going to change your P&L and your subsequent measurement of interest expense, which will in line affect all these questions that we're coming up with. So if you're going to make an exception there or an alternative there, I think we had to answer this question of how does interest affect user relevance? And that's why I think I raised this project as a focus area, because I didn't want us to get confused by the complexity of how do you do the accounting when you change your debt. I wanted to focus on interest expense. And I think now we can at least have the issues at hand that we need to answer of what is relevant or not relevant. So to answer your question too, I do think this is practice. I'm very skeptical that people or auditors are fulfilling their requirement to state that it is actually material or immaterial in practice, at least within the private company space. I think a lot of files are missing. I think they just make the broad claim this is immaterial versus straight line, but I don't see an effective interest rate method when we assume files or review audit files. So I don't know how we reach that conclusion. So I don't know if we think it's a practice issue because we don't have any objective data to support that.
Adam?
I tend to share some of the concerns, cost versus benefit on this particular project. If we were to proceed, I would keep it as simple as possible in terms of scope exceptions. It is interesting, cash keeps coming up. One of the interesting notes I found in the paper is that this could impact the disclosure of cash paid in the statement of cash flows because it would change the calculation of interest and the allocation of the payments. So while we say it's cash, that disclosure is likely to change in addition. I don't have a lot of concerns on the audit side. I understand some practitioners might not have files, but auditing standards are what they are. There's a general risk assessment process. There's a number of filters that could dictate the extent of documentation on some of this. I know many professionals I've spoken to about this topic kind of look at me like, why are you doing this? What, like, so I just wonder if it's the best use of our time.
Thanks for that. David F.
Yeah, I mean, kind of going back to what Katina, Mike, and Adam have said from a practitioner standpoint, when it's immaterial, you in your risk assessment, you usually kind of just make do with the straight line. But when it looks like it is actually going to be potentially material, or you do have a substantial discount, we usually will more likely affect and push through an effective method, at least from our firm's aspect. When you have large discounts, it makes more sense and probably more financially relevant information to apply it from that aspect. So, I mean, I think our order of operation should be more likely be focusing on debt modifications and kind of push this to the back burner, or move on to something else.
So what would the PCC think of that as a call to no action on this further, and recognizing that we are, and I know the FASB is also, we'll talk about that later, thinking about this sort of modification of debt concept. Is this better rebirthed in that dialogue? Or do you guys want to push forward with this as being a potential project? I'm not asking for a vote on adding something. It's just, do you want the staff to do more work right now? Mike?
So I do think it's a worthwhile project from just the interest approach, but I'm okay with canning the project if when we go to the debt modification guidance, we don't have the same issues. If we're comfortable saying that interest expense and subsequent measurements going to change, and we're going to go through and fix that problem, we don't even have to look at interest rate method. I don't want to run into the same problem because I think we're going to have the same exact issues. So I think it's worthwhile, but I'm okay I'll be more than happy to support not pushing it if we fix modifications.
Others? Adam?
Well, I'm excited to hear about the debt exchange project later today, because I think that's where we last concluded on modifications, was just kind of put a hold and catch up on what the FASB's project was on exchanges. But as I think about it, canning it might be a hard term. I like the concept of the back burner David put out there. We can just put a pause on this, maybe focus on some of the modification topics, and then revisit this if necessary. Is that an agreeable approach?
Katina?
Yeah, maybe just to answer the question a little bit more directly, I don't think we need anything else from the staff on this topic right now.
I hear Bradley. You think the same?
Yeah, I agree with that.
Doug, in views?
I'm sorry, what was the question?
Do we want the staff to do more research on
Yes.
this topic?
Yes.
Okay. David?
Now I'm in agreement. I think we've got enough.
All right. Robert? You want him to do more research on this? Okay. Holly?
I don't think we need more research. I think right now the debt mods is the forefront and we can kind of put this on hold until later on.
All right. I'd say that's kind of a 50-50 approach without really counting heads. So, David?
I mean, if this is something that is going to be, that we're still going to take up a debt modification project in the future, and this is something that we may spend a lot of time here now and then have to revisit it through that process, that's kind of where my concern over resources, comes into play. And that was my recommendation for why it should be on the back burner to figure out what we're doing with that project before we take this on, because it will be impacted by that.
Okay. Doug?
And to clarify my vote too, I think where I kind of sit in my verbatims, I think there's just so many interwoven issues between the mod discussion and what we're talking about here that, like, when I say I want the FASB to do more research here, it's kind of in respect to the broader foundational issues that are going to exist when we get to the mod extinguishment potential simplification. So I don't, if we just ignore it here, then we get to mod, we're going to come up with the same issues. So I think one way or another, we're going to be asking for a little bit more digging into some of the issues. So that's kind of why my answer.
Well, but my question really is trying to focus on, do Chris et al. On Monday of next week, go back out with this as a paper and say, okay, these are the things we're going to do on this topic in a silo. And if the answer is yes from you guys, cool, then that's what we'll ask them to do. I think the answer is really, we don't want to forget about this, but we really want to figure out what we're going to do about debt. And this is a component part of that. Is that a fair statement? So, which means Chris isn't rewriting this memo on Monday.
Yes, I would agree with that.
He's going to turn it into 39 pages. Rich?
Yeah, I just wanted to share, I appreciated the discussion. I think there are a lot of good points. If you do revisit this and your main focus is simplification, consider, and given the input from users that they only care about cash interest paid, consider whether the right answer is just to charge this off to expense day one versus straight line, because you're effectively saying effective interest is not relevant. And if that's the case, then why would you burden it with a straight line amortization that you also think is not relevant? If you want the simplest is charge it off day one. Then there's no accounting. And I don't know what the appetite in the group is for that, but that would certainly be a simplification answer.
Mike?
I'd be okay with that. If it's, but only on the discount and premium and debt issuance costs, not the contractual interest. And the contractual interest should get retained if that was the approach.
Katina? That's an old flag. Okay. My reaction, my instructions is as we talk about other debt things, this will be re-earthed, but this will not be a topic in December in and of itself. So thanks for that. I was actually going to put Chris on the spot, but I won't, to say, tell me what you think we should do.
No, I will just say on the debt mods, on the debt mods front, we did have some feedback on that, but in our most recent round of outreach, we were solely focused on accommodations to an alternative to the interest method. So notable that there's some thoughts on something broader than that. So just wanted to highlight that. We did write a little bit about the paper, but not in that direction.
That's good. That's good feedback for us. Okay. So we have a 7-minute break. Maybe 8. But so let's start back at 10, I'll say 10:35 or 11 minutes from now. Thanks for the dialogue.
Take over with that law.
So I think we're close to having everybody back in the room.
Yeah, hey, Rob. Hey, Sam. Sam, are you ready to get to that?
We're already ready.
Okay, awesome. Thank you. Why do I
Whenever you
even
guys
ask?
are, I'm ready.
Why do I even ask?
Okay, welcome back. Great dialogue already today, and hopefully that'll continue as we go through the next topics. And so next up is our topic 5, accounting for debt exchanges. And I think Julie is going to lead us through. Thank you.
Thank you, Jerry. The board completed its discussion on debt exchanges recently, so we just wanted to provide a brief update. As you remember, this project was recommended by the EITF. The board agreed with the EITF recommendations and issued a proposed update in April. Earlier this month, the board discussed feedback received and decided to move forward with final update. Next slide on the issues raised. Under current GAAP, determining accounting for debt exchanges requires the 10% cash flow test. Some stakeholders said the test is complex and may not reflect the economics of exchanges that are independent transactions. There's also diversity in practice on whether the test is always needed. Moving on to the next slide. To address these issues, the proposed update introduced 2 new conditions to streamline accounting for debt exchanges. 17 comment letters were received, mostly from practitioners, practitioner groups, and trade groups. Overall, respondents supported the proposal with some suggestions for improvement. Some comment letter respondents recommended a separate project to reconsider debt-related issues more broadly. One respondent recommended further simplifications for private companies, citing the complexity of current guidance and the limited impact of the proposal. Next slide on the final amendments. In terms of the scope, the guidance applies to debt exchanges where the new debt issuance has multiple creditors. Many comment letter respondents supported expanding the scope to either multiple creditors or single creditor in the new debt issuance. However, the board considered the proposal is intended to address issues in exchanges with multiple creditors and decided to affirm the proposed scope. There are 2 conditions to qualify for the new guidance. The first, existing debt is repaid at the contractual terms or repurchased at the market terms. Second, new debt is issued at market terms. The proposed update included additional requirement, which is to follow customary marketing process. Comment letter respondents raised many operability issues about assessing customary marketing process. After considering the feedback, the board decided to remove the proposed requirement. Moving on to the last slide. The final guidance will be effective after December 15, 2026 for all entities. Transition to the new guidance is required prospectively with disclosure of the nature and reason for the change in the period of adoption. Early adoption is permitted as of beginning of an annual or interim reporting period. With that, I will turn it over to you, Jerry.
Thank you. Obviously the discussion today was to update us on what the FASB's done. I think we're going to have another ability when we talk about the agenda consultation process. Nellie, is that true? Where some other considerations the FASB may have going on around debt can come to light. But with that, are there any questions or comments that the private company counsel would like to give to the staff or the board related to the debt exchanges topic? Mr. Chang.
I think this project makes sense. It makes it easier for, I would say, larger private companies that have syndicated debt arrangements because of the scope. I'm not as happy it landing in extinguishment accounting, but I still think it's a lot easier because you avoid a 10% test and going through the model. So I do think it's an improvement, and it's, yeah, so that's all.
Thanks for that. Others? You guys wore one another out, huh? Awesome. Thank you, Julie. All right, we'll gather now that the team is coming in to discuss the research project leases and the FASB leases post-implementation review project. You guys ready? And then Ashley's going to lead the dialogue.
Okay, thanks, Jay. So since we last met in June, the FASB staff has continued to work on wrapping up the Leases PAR project, and the working group recently met on the PCC Leases research project. So starting first with the Leases PAR project, the board met on September 3rd to discuss the PAR activities that have been completed since the issuance of the standard. On September 12th, the FASB hosted a public roundtable, the purpose of which was to solicit additional feedback from those who have experience in implementing the standard. Mike Chang was in attendance from the PCC, so thank you, Mike, for your time and your input. We provided a summary of that discussion at yesterday's closed session with TIC, but I will provide a quick recap again today for those who weren't in attendance and for members of the public who are viewing the meeting today. So overall, participants agreed that implementation was costly and resource intensive. Preparers indicated that ongoing compliance costs persist, particularly around system maintenance. Participants also agreed that the standard achieved its primary objective and provides users with more decision-useful information. Participants did not think that any broad standard setting to leases is necessary, but observed that there are potential areas for targeted improvements, although most did not think that any of these areas should be a high priority. I'll briefly highlight some of the key areas that were discussed. Participants observed that embedded leases continue to be a challenge from both the lessee and lessor perspective. Participants also discussed the complexity of accounting for lease modifications, particularly around partial terminations where some confusion persists. Users noted that while they appreciate the enhanced cash flow disclosures, the lack of specific cash flow guidance for the changes in operating lease assets and liabilities results in diversity in practice that creates complexity in their analysis. Participants also discussed whether adopting a single lease classification from the beginning would have reduced costs and whether such a model could still offer benefits today. A private company practitioner noted that more transparent disclosures about common control leases are needed. And lastly, a private company practitioner expressed that an exemption similar to that in IFRS for low-value leases would be beneficial to small private companies. Now moving on to the PCC Leases Research Project. In July, the Leases Working Group met to discuss private company stakeholder feedback, additional outreach needed, and next steps. Working group members emphasized the importance of understanding and conducting research on private company stakeholders' concerns to support the ongoing application of the Leases standard. Working group members also provided their preliminary perspectives on several potential private company simplifications. So with that, I'll open it up for discussion on questions 1 through 3, which asks whether PCC members have any questions or comments on activities that have taken place on either the PCC Leases Research Project or the FASB Leases PAR project, and whether PCC members have any questions or comments on next steps.
So I appreciate, in particular, the Lease Task Forces Committee, if you guys have any comments that you want the broader group, including the public, to know about the sort of things we're thinking about. And we did have a robust dialogue with TIC yesterday about some of these concepts. Doug?
Yeah, I'm happy to give just some overall feedback. I would also like to express I was on a wonderful Hawaiian vacation and was unable to join the Leases Roundtable, but just know how much it pained me to not be in attendance at that event. So thank you, Mike, for representing us well. I think one thing that I'm encouraged by, so I am a member of the Leases working group, and I think it's always encouraging to feel validated in the work that you've done. And so I think a lot of the dialogue that came out of the roundtable emphasized a lot of the things that we have identified within the working group as far as areas of potential simplification. I think this came up with Tick yesterday, and I think even in our closed session as we were preparing, I think it's important, and I think it's important for the public to hear too. You know, we're approaching the leases topic with a sense of trying to accomplish objectives for all stakeholder groups. Inherently, I'm going to have a little bit of bias as a preparer to seek simplification for those of us in the preparer community, but we know that users have, specific needs as it relates to lease accounting that we don't want to overlook, as well as obviously the practitioner needs. And so we are taking a holistic sort of approach at this. I think the other thing, and we've been talking about leases for a long time, is just leases is hard. It really is. It's a difficult standard. The move for 842 to put things on the balance sheet creates a lot of complexities that, you talk about something like embedded leases, that existed prior to 842. Well, the second that you start putting these leases on the balance sheet, it just brings a new heightened level of visibility to complexities and challenges that may have just been overlooked before those things went on the balance sheet. And so I think we as a working group, and even as a PCC more broadly, are wrestling through this. We acknowledge that it's difficult. We acknowledge that there's just inherent challenges with leasing, and how do we really seek to find ways to improve and simplify where possible, but not sort of derail the underlying improvements that the lease accounting standard through the release and implementation of 842 brought to standard setting. And so maybe I'll just touch, briefly. I think up until this point, the working group has been focused on, I would say, and this is Doug's words, and I'll let David and others join in, but I think it's been one, fact finding. So it's really trying to diagnose and understand what are stakeholders seeing as far as areas of complexity. And we really wanted to make sure we understood the root there, because it's like, well, we could start to try and simplify and start to try and improve, but if we don't actually understand where the issues are really arising, then we're not going to do that. So it's been a very intentional effort to do that. And then I think the discussions up until this point have been to sort of narrow in, okay, what have we heard? And are we all in alignment on that? And so I think the three big things that I think Ashley did a good job summarizing: single lease classification, which of all of the things that we've talked about is probably going to be the biggest hurdle to overcome. But, the more dialogue that we've had, there's just been a lot of indication that moving towards a single lease classification would provide a lot of simplifications, a lot of differing areas within lease accounting. Lease modifications comes up all the time, and then embedded leases. And so I would say for those three topics, where we're at as a working group and where I think our next steps will really be are to now start to talk about in more detail what are the opportunities within those spaces. I think they've started to come up a little bit, but we haven't, outside of maybe people throwing out some ideas, we haven't really pressure tested them at this point. And so I think that's really, again, speaking from my knowledge of where we're at as a working group, is that's where we're really going to be honing in on. I think our conversation with Tick yesterday was really insightful. They brought some potential disclosures, so the weighted average disclosures within the leases footnote, as well as the cash paid disclosures, could be potential areas where we could look at, from looking at simplifying what private companies may be required to disclose. That could kind of tied to some of the weighted average disclosure discussions we've had on a more broad basis as a PCC. And then I know the topic of related party disclosures for leases has also been a hot topic and something that we are carefully trying to consider. I think it was covered in the materials. I think we've sort of addressed as a working group, we're maybe deprioritizing a little bit the related party disclosures in light of some of the other potential simplifications, simply because I think there's potential that it could be an educational matter. I think there's a lot of related party disclosure guidance out there today that would satisfy the needs of a lot of users, that I think if there was broader education about what types of things should be disclosed related to related party transactions would maybe cover a lot of user needs with respect to leasing that wouldn't involve adding a bunch of new lease specific disclosures. So I would say that's an overall summary of kind of where we're at with leasing. And, we just know we're hearing constantly from our stakeholders that it is a high area of importance. And so I think we, as a working group and as a PCC, are trying to really balance the complexities and challenges with making wholesale changes to the guidance, but also making sure that we're addressing the needs of our stakeholders. And that is a delicate balance and it's challenging, but we remain committed to having those dialogues and discussions and hopefully ending up in a place where we can bring, some real value to our stakeholders in that respect. So that would be my summary.
Thanks for that update. Bradley?
I just want to comment on the relevance of the topic. So some colleagues and I had got the idea to try and understand better the financial reporting practices of private firms in general. And so our approach to this was send out 40,000 emails to private company CFOs. And I won't surprise you, but all 40,000 did not respond back. But 650 did. And of those 650, we asked a series of questions, one of which was we came up with a number of accounting topics and asked them, what are the decision usefulness of the information you get from following GAAP standards on this topic, and what are the costs that you incur, the challenges? Of the 9 topics that we included, leases is the only one where they said their costs exceeded their benefits. And I recognize there are benefits to users that are important for us to consider, but I did think it was notable to at least bring it to this group that from 650 randomly emailed CFOs, this does seem to be a pain point. And my concern moving forward, because I think we need to move forward, but my concern is what we can do within what's allowed within the private company decision-making framework. Some of the things we've talked about are very large in scope, and I'm not sure they're within what we are being asked to do. And so how we get this group satisfied within what our boundaries are is a good challenge.
Thanks for that. Thanks for that feedback. Robert?
I do think this is extremely important. And as a user, I think it has proven very valuable to have this additional transparency by seeing the leases on the balance sheet. I do appreciate there's a lot of pain associated with this. And I'm pleased with the working group and the work of the PCC to try to make things simpler and make them more usable. I think we need to relieve the pain, but I don't want us to lose sight. For folks like us as users, this has really been important and it is very, very insightful. And for us, the pain has been worth the gain because we're getting lots of gain and we don't have much pain. So I think we need to continue to move forward and work on this.
Thanks, Robert. Michael?
I think you were just jealous you couldn't go to the leasing roundtable. I had a much better time than him in Hawaii. So it was a very enlightening discussion. I think it reminded me the importance of kind of where the project was, and this is a lot of history to it, right? So if we decided that these are obligations and they need to get put on the balance sheet, I think a lot of our constituents are struggling with that one fact. I think if you were to ask a lot of our private company stakeholders, and we've been going to engage in all these town hall meetings, this is the one topic that gets consistently raised as, why aren't you doing anything for us? And I think my interpretation of it is they're asking for us to not record the liability. And I think what they really want is to book cash basis expense. And my personal view is I would never accept that, because I think if you have a liability, it's a very, very high threshold to make an exception for a recognition and measurement threshold difference between private and public companies. So I do, understand that pain. It's a challenging exercise. And once you put the liability on the books, it becomes very difficult. And I think, Doug, your working group with the leasing roundtable and your research, Brad, right, that's indicating that this is a very costly exercise. I guess reinforces the idea that we need to continuously improve this and make things easier. I think there's a lot of ideas to move forward. So we got to make this less painful. So I do hear that loud and clear, but I think I'm curious on where, how other PCC members feel in terms of just writing this off and not booking a liability, which is what I think a lot of our users at these town halls are asking for. And the other thing is it is relevant. Every discussion that I've encountered, users kind of have the same sentiment as you. Is it exactly what you want? No. And could you improve it? I've never heard anybody tell us from a user standpoint that it's useless information. I think that there's an improvement. It's just how far. But I'm sure there are users that have said it's not good. I just haven't run into them.
Touchdown, Doug.
Yeah, just to be clear, and for the sake of, we as a working group have not discussed at this point any appetite for completely going to a cash basis non-balance sheet model. So just for avoidance of doubt, that has not been even something that we've addressed. It's been within the confines of the recognition and measurement guidance. Not to say that we're not exploring potential recognition and measurement differences that will, to Brad's point, put pressure on the PCDMF and will require careful consideration. Going that far as to say, hey, we're not going to require these on the balance sheet is not something that as a working group we've discussed at this point.
Thanks for that, Doug. David?
Yeah, I'd say as a user, right, having more information is always better than having less, although piling a bunch of aggregated assets and aggregated debt on the balance sheet isn't giving me much disclosure at the end of the day, so I'm not sure how beneficial the numbers really are for me, right? If you gave me a schedule and disclosed all the leases and who they were between, that would be great. But, more important things like off balance sheet, guarantees and debt would be more important, but we're not addressing those, right? And so I don't know, I guess people like to see the liability or think that the lease is a liability. And so I guess that's great, but not trying to undo what has been in the works for 11 years now. But just some thoughts on, or maybe some questions around, is there some level of low value leases that get us any traction at all? Seems like low hanging fruit, just in terms of if you are a user of financials, do you really care about the smaller, and what is small, right? Like if I'm a user, if you've got really large leases to one counterparty that's not related, then that probably is where I'd want to focus my attention. But again, aggregating a bunch of numbers together and putting them on a line item, not seeing the value outside of knowing they're there, I guess.
I think, because I sit in on the working group, I think how might materiality conventions be discussed? Accounting policy conventions. I know materiality, I was actually thinking about this morning, so I'm a very exciting guy. There isn't a standard setting body that owns materiality. And I'm not suggesting that the FASB should be that one, but the Auditing Standards Board avoids it, the PCOB avoids it, the SEC avoids it. Nobody wants to define it, at least in the US. And so the question is there an education policy? I mean, I think a lot of companies expense a lot of assets that you could argue should be capitalized because they've concluded they're not decision useful. Keeping around a bunch of $10,000 items, even if they add up to millions, is irrelevant. Do we have a way to help the practitioners and preparers think about materiality in a more global way than around what a 5% number or some number might look like? I'm not saying that we're in the position to do that, but my impression is, at Engage, we have people saying, "Oh, I have a $3 million company." I'm like, I don't know why you're freaking accounting for leases at all in a $3 million company, right? But that would be the way I would approach it if I were working with them. And so the question is do we encourage people to think more broadly about what presentation and what reliable information is? Again, that's not a standard setting concept, though. That's an educational one.
Yeah, I was looking around the room. I see we have 7 more minutes on this topic, and I want to use every single one of those minutes allocated. My ask maybe would be for this group of this, particularly as I'm thinking about the next steps of the working group, if we're going to explore, and this maybe even is in reaction to some of the user comments we've had in the room, when we think about a single lease model as a potential avenue to explore, there's a lot, and we don't have time to go through all the reasons why, but when you think about just the inherent complexities of lease classification and getting underlying valuations of the leased asset and all of those things, a lot of those things go away with a single lease classification, and it's still on the balance sheet. I think one of the other things that are oftentimes overlooked, potentially by those that aren't doing the calculations and recording them on the balance sheet, and Mike, you made a reference to this yesterday, was for finance leases, they go on the balance sheet, and then you amortize the liability like debt, and you amortize the asset like any other fixed asset. For operating leases, because we want to maintain that straight line expense recognition on the balance sheet, or excuse me, on the P&L, the balance sheet amortization of the right of use asset is inherently an accounting plug. And I think we have developed systems, accounting systems, to handle that today. And so for companies that have adopted the standard, it does that. But it does create, I know if Mike Minnis were here, and if you're listening, Mike, I'm shouting out to you here about this disconnect between the P&L and the balance sheet that exists for leases. And it just intuitively doesn't make a lot of sense. And so I think, again, what I'm trying to probe here is if this is a direction we want to go, it is going to create like potential differences in comparability. If let's say we got to a world where for private companies, we allow you to elect as an expedient or an alternative to use a single lease classification that would be in alignment with IFRS. What would be your reaction to that? The liability is still on the balance sheet. I would argue there's now more consistency with how that expense, for all leases, your expense is going to hit amortization and interest, versus today in this dual model, it kind of exists all over the place. But how would you react to that? Because I think as we explore that as a potential, I would be curious to kind of understand. I think what we want, we're cognizant of going down a path that this would be certainly in the realm of recognition and measurement differences and would require a lot. So if I think from the user perspective, we're going to need some feedback. And I do think from a cost and a simplification perspective, it could offer a lot to private companies. But obviously from a user perspective, I think it's going to be a very interesting thing to go through. So just a little probing discussion there.
Thanks, Doug. Adam?
Yeah, I think it's worth exploring. I struggle with every time leases comes up because we're trying to look for simplification improvements. And I know a large population in the private company community just wants it to go away. And I don't really see that as one of the options, particularly given the user community who very much wants these disclosures. So I kind of like the idea of at least exploring what a single model could look like if we really think that would be an option to simplify as much as possible. At least it's thinking bigger than just more ad hoc. So the other thing with the leasing standard, and I give many of the folks in this room and the people who came up with the standard, there's a lot of simplification and expedience in that standard up front. And I struggle when we talk about low-hanging fruit because I'm like, I think the low-hanging fruit's in the standard. So I certainly would encourage continued discussion around that topic, is maybe thinking about bigger simplification ideas.
Thanks, Adam. Christine?
So one thought that might make it more palatable to investors if the group were to want to explore a single model, and that would be also addressing the classification of the lease payments on the statement of cash flows. Because one of the reasons why investors, I think, prefer the operating lease accounting is because it classifies those lease payments as operating activities, and you don't end up with a disconnect between free cash flow and net income, because both net income and free cash flow are reflecting the cost of the lease. I think you might get an objection from investors if you said, well, we're going to go with a single model and now all lease payments are going to go down into financing activities under financing leases, because that is going to create a big disconnect for them with free cash flow. So you might be able to overcome that hurdle by also addressing the classification of the lease payments and making them all operating lease payments regardless of the classification of the lease.
Doug?
And just to be clear too, it wouldn't be all of them in financing. It would be just the portion related to the principal. So you'd have the interest component of a finance lease that would still be
Yeah, but
in.
the principal component is the biggest component, right? And so what's happening is the whole lease cost is going through your income. But now the cash side of that is being ignored in the calculation of what is essentially cash basis income because it's down there in financing, and that's the problem.
Great dialogue. Only thing I can promise for sure is that we will talk about leases again. And we're in the process of now getting ready to have the working group meet again and follow up on how the post-implementation roundtable proceeded and what we might do next. And we have the benefit of the TIC members who were here yesterday are also members of the working group like David and Doug are. So thanks for that discussion. And now we'll move on to the next topic, which is the agenda consultation. And the crowd will gather. Awesome. Welcome back. Haven't talked to you guys since June, but a lot's happened since then. So I think, Tiffany, you're leading the charge.
Quite a lot has happened since June. We can move to the next slide. Alrighty, so if you recall back in September, I'm going to take us way back. In September, we met with you guys to ask you what the board should work on next. And that feedback, plus other outreach that we performed during the second half of 2024, created the contents of the invitation to comment for agenda consultation that was issued in January of 2025. And I'm just going to call it the ITC for simplicity. So in the creation of that, we talked to over 200 stakeholders with a variety of backgrounds on what the feedback should be, and that created the content there. And just as a reminder, the invitation to comment is a staff-only document, so it doesn't include any board points of views. So moving to the next slide, the FASB received over 129 responses as a result of this ITC. Feedback was received from comment letters, outreach meetings with advisory groups, much like yourself, and stakeholder outreach meetings as well. As you can see from this pie chart, we received feedback from a cross-section of stakeholders, which included investors, preparers, practitioners, trade groups, and other types of stakeholders. And they come from a variety of industries such as financial services, pharmaceutical companies, oil and gas, energy, crypto, just to name a few. So if we move to the next slide, this will give you a high-level overview of what the topics were that stakeholders concentrated their feedback on and how they prioritized them. So this slide highlights some select topics that were included in the ITC and the percentage of total responses and those that identified it as high or low. There was a wide range of perspectives received across all of the topics. While some topics were consistently identified as top or low priority by stakeholders, other topics had more varied responses with views split between top and low priority. Also, even when topics were consistently identified as top priority, the feedback was often diverse on how the board should address those issues. So, for example, stakeholders identified risk management and hedge accounting and outdated disclosures as top priority, but they provided numerous recommendations on how the board could address issues in those topics. Additionally, stakeholders were generally aligned that certain topics were of low priority, such as recognition of interest income and estimate of variable consideration. And furthermore, there was differences in views between practitioners, preparers, and investors about what topics the board should address. So generally speaking, investors provided feedback about wanting the board to address topics related to enhancing financial reporting information, and practitioners and preparers primarily identified topics related to making targeted improvements to reduce unnecessary complexities in GAAP. So if we move to the next slide, this is a nice reminder of topics that we spoke about with your group in June. So when we met in June, we discussed 7 topics, and this is and these 7 topics here is what the total feedback was related to those 7 topics. So as a reminder, PCC members stated that equity method of accounting, distinguishing liabilities from equities, consolidation, the definition of a business entity, and employee stock repurchase plan obligations, that those related disclosures were top priority. And then the definition of common control and multi-element software arrangements were identified by PCC members as a lower priority. So for the first 5 topics listed here on the slides, stakeholders provided mixed feedback on the priority for standard setting, but they did provide several solutions that the board could consider, some of which would be more targeted improvements and some of which would be broader projects. While ESOP disclosures and multi-element software arrangements were considered lower priorities overall from stakeholders. So if we move to the next slide, which I know is going to be very busy, so I'm not going to go into a lot of details, but this highlights the overall feedback that we received on the ITC and what priorities stakeholders identified them as. So this chart demonstrates the high volume of feedback that we received, but also the diversity of that feedback. And I just wanted to highlight two topics that you guys discussed yesterday. So your group and TIC discussed debt modifications and extinguishments. We also received feedback on that, which is included in the line called troubled debt restructuring by borrowers. Stakeholders identified debt modifications and extinguishments as a top priority, noted that the current guidance is complex and challenging to apply and could be simplified. And stakeholders provided a variety of suggestions on how to simplify that guidance. And additionally, we also received feedback similar to your feedback on embedded derivatives, which is included in the line item definition of derivatives and derivative modifications. Stakeholders noted that the bifurcation requirements often involve significant judgment and suggested several solutions for the board's consideration there as well. And then if we move to the next slide, this is on next steps. So we're in the process of summarizing this feedback for the board, which will be presented at a public board meeting early this fall. And the board will analyze this feedback against its agenda decision criteria as part of its overall agenda prioritization process, and then decide how to make changes to both the research and technical agendas. And once the board completes analyzing the feedback received on the agenda consultation, we'll issue a summary of the feedback and how the board considered all the feedback that was received. And this brings us to three questions that we have for you today. So the first is, do you have any observations or questions on the feedback for areas discussed by your group in June? And the second is, are there any areas not discussed by the PCC in June that you would be interested in potentially learning more information? And then the third is, do you have any questions or observations about the overall feedback?
Robert?
I think I brought this up before, but to me, it continues to accelerate, and that's cryptocurrencies. The last time we talked about it, it was really an intangible. Now it really is accelerating to be used to settle accounts. I'm not sure that it makes any difference in what we found before, but I sure don't want us to get behind on this. I think we need to be very sensitive about that as it continues to emerge.
Nellie?
This is on my list for our updates in other business earlier, but Rich did add a project to the research agenda on digital assets a couple of months ago. So that is definitely on our list of something to think about.
Thanks, Nellie. Doug?
Yeah, I'm just curious as to, and I know you guys are still kind of digesting all of the responses to the invitation to comment, but I'm curious for all of the topics that you guys heard about, if there's any data that you've sort of captured that would say what of these topics were more prevalent amongst private companies specifically, or are there certain items in here? I'm just almost maybe probing a little bit for a future meeting of like, is there a broader or an understanding within some of these topics that are specific to private companies that we might want to understand? I know that's part of what you guys are asking of us, of like, if, as you look at these, or does anything come to mind? And I'm just curious, like, to the extent that any of these items were more prevalent amongst the private company respondents that we would want to highlight to look deeper, and if that's data that you've captured at this point in any respect, I'd just be curious.
Tiffany?
Yeah, Doug, we actually did. So in some of the letters, some folks did talk about the board needing to coordinate with the PCC on certain topics. So we can share that with Jerry and Jennifer so that you guys can get that information. So we do have a preliminary list.
Great. Maybe that can be something that we talk about, for some period of time in December, and what impact it might have on our own agenda priorities, if any. Mike?
Thanks. And I don't know if this is gonna impact. I think there was discussion on education sessions, right? And then I think your question is what information you would need. It doesn't surprise me that, or actually I'm happy to see equity method being third on the list. I think that affects private companies not disproportionately, but it's pretty pervasive. It's a common area. I mean, just getting into the scoping of it, once you're in it, accounting for basis difference, understanding the differences between a corporate model and a partnership model, and really how it unwinds. And then for users of financial statements, if there is a change or how they assess basically EBITDA measures that are embedded within the investee, right? A lot of times you take your proportionate share of the P&L, but within that P&L, it also has depreciation, amortization, interest, and taxes. So I think having a thorough understanding will allow us to bubble that issue up and provide better feedback from a private company perspective.
Great, thank you. Holly?
I think the thing that I saw were there are two kind of high priority, the enhanced disclosures and the statement of cash flows. And I guess it would be interesting learning more if it was going to end up bringing more work for private companies or more disclosures, more work. So those were the ones that would. Yeah.
You may have noticed this, but enhanced disclosures on this slide with all the different topics, enhanced disclosures is quite near the top, but so is outdated disclosures. So the board has some work to do to balance that. And response.
And Holly, to that point, I might combine those two and just talk about disclosure effectiveness. Because I think when the PCC discusses disclosures, that's really what you're getting at, right? You're trying to understand from the users what disclosures they find helpful, preparers, which ones are overly burdensome, and then between those two, how do you improve just the effectiveness of disclosures in the financials? So I hope as a board, as we look at that, that's the way we approach it, is more along the lines of effectiveness versus a goal of increasing or decreasing.
Thanks, Rich. So when does the board meet to talk about these? Which started Sunday?
I mean, Jerry, ideally, the last time we did this, right, we got some more volume of responses, albeit more targeted, right? And in some cases on larger scope projects, including some projects that have been around for a long period of time. Ideally, we would bring all of these topics back to the board between this fall and sometime next summer. That's our goal. That's what we're striving for. Will we hit it? I don't know. It'll depend on there's a lot of things in here, and our staff is working hard to pull the relevant information for our board together. But that's what we're shooting for, is to bring all these back and let our board make decisions.
So as you're doing that, again, sort of feeding off the question about how many were raised by private company affiliated entities versus public affiliated or not-for-profits for that matter. Are there some that we should be thinking that would be a high priority for me, but for us, but would not be that for you guys? That's more of a probability thing, I guess.
Yeah.
We try to avoid.
And I can't envision, there's pretty few items on this list that I wouldn't envision we would want the PCC input on, right? I mean, we need it.
Jackson?
Yeah, I was just going to observe that there'll be plenty to talk about when we discuss this topic in December again. So,
any other questions or comments? For now, I'm sure we'll have other questions and comments. Doug?
Sorry, one just came to mind, and maybe I'll just probe it. I don't think there's an immediate response. I see principal versus agent considerations near the top, and I feel like that's one that always pops up a lot and is certainly one that's near and dear to my heart. So I would just say that as the staff maybe unravels that a little bit, I think that would be something that, as we learn more about what the feedback was in this particular ITC, I think that could be another one that the PCC would probably be, at least me specifically, but I'll speak on behalf of the rest of the PCC, would probably be interested to learn more about. So anyway, I just call that one out. Thanks.
Excellent. Thank you. See you soon. Welcome. And so topic 8, the FASB research projects. And I think Alana is going to take us through.
Thank you.
All right, so I know we spoke to you about this topic back in December at the PCC meeting. So I figured I'd start with a quick refresher on the project and really focus on the feedback that we received since the ITC was issued. So on the screen, you'll see an overview of the project timeline. I know you just spoke about the most recent agenda consultation, but the KPI timeline goes back to the previous agenda consultation. So back in 2021, we received feedback on KPIs as part of that agenda consultation. A project was not added to the technical agenda based on that feedback, but the chair did add a project to the research agenda on financial KPIs. The staff has performed research on this topic, resulting in the ITC that was issued in November with comments due at the end of April. So I know the materials were shared a little bit ago, so the next step on here was to discuss with the board, but we actually did that this week on Wednesday at our most recent board meeting, and we discussed the feedback that was received on this topic, and the board shared preliminary thoughts on the feedback as well as maybe potential areas to focus our research, but no decisions were made at that time because the board will be considering the broader feedback on the agenda consultation, on the most recent agenda consultation in October. So we can move on to the next slide. So a quick overview of the research project. The objective is to think about the perceived issues associated with KPIs, those being pervasiveness as well as comparability, as well as if there are feasible solutions that exist to address those issues. Whenever I talk about this topic, I like to make sure that the scope of the research that the staff is working on is clear because we are aware that there are many definitions of financial KPIs that are out there, but the focus of our research is limited to financial measures that have two conditions. The first is that the measure is calculated or derived from the financial statements or underlying accounting records. And the second is that they are not presented in the GAAP financial statements. So thinking about those two criteria, the financial KPIs that are not included within our scope are financial statement performance measures, totals and subtotals. So those items that are included within the financial statements, as well as non-financial KPIs. And this is important to mention because we did receive feedback from respondents on some KPIs that would be without the scope, be beyond the scope of a potential project. So I just wanted to clarify that up front before going through some of the feedback that we received. We can move on to the next slide. So the questions in the ITC were focused on 5 broad buckets of feedback for us to receive. The first being the relative priority of a project on financial KPIs. The next being the pervasiveness and comparability, so those perceived issues I mentioned associated with KPIs. And then the ITC included potential approaches to standard setting. So we have approach 1 and approach 2. As well as broader feedback on the preference of approach, including approaches that may differ from the 2 that were outlined in the ITC, as well as suggested disclosures. So today I'll share some of the feedback that we received on those 3 buckets in the middle. You can move on to the next slide. So this slide really just shows you the broad, diverse group of stakeholders that we received feedback from via the comment letters. We received 37 comment letters across a variety of respondent groups, which is always what we're aiming for when seeking out feedback. I'd also mention that in addition to the comment letters received, we did solicit feedback from advisory groups, as you were part of since the issuance of the ITC, as well as academics and users. So we made sure that all of that feedback was summarized for the board and will be considered as part of the project. We can move on to the next slide. So the 2 main perceived issues associated with KPIs were prevalence and comparability. I would say that the feedback on prevalence was pretty consistent, and broadly the feedback on this ITC was very diverse, other than in this category for prevalence. And that being that we did hear these are being reported by companies and they are being used by investors. In terms of comparability, feedback was diverse in that some stakeholders thought comparability could be improved via a potential project, but there were others that noted that the comparability is sufficient because it allows companies to communicate their entity-specific results via these KPIs. And some noted that standardized KPIs may not provide as useful information if companies aren't able to report those entity-specific or wouldn't be reporting those entity-specific KPIs under a potential FASB project. And we can move on to the next slide. So the first approach in the ITC would define or standardize certain commonly used KPIs. The feedback on this approach was mixed in terms of the potential benefits of standardizing KPIs. There were mixed views on whether standardization should be broad or industry specific. And I'd say that this feedback overlaps with what I mentioned about comparability. So some stakeholders mentioned that if companies are required to report standardized KPIs, then maybe that information won't be as useful or relevant as across industries and different companies. The most common suggestions for standardizing KPIs were EBITDA, free cash flow, and current ratio, which we had heard and was consistent with some of our preliminary research on the topic. And finally, many said that disclosure of defined measures should be optional and not required if the FASB were to pursue an approach consistent with approach 1. Moving on to approach 2 that was included in the ITC. So this was an approach focused on management defined KPIs. I would say that that many conveyed a lack of support for this approach. So this would bring management defined KPIs into the GAAP financial statements. And the concern around this approach was really focused on operability, auditability, and also the potential costs associated with an approach that would be consistent with approach 2. I will say that based on our discussion earlier this week, board members, I think, agreed with some of the feedback we heard, and that an approach 2 doesn't seem like the most technically feasible or cost beneficial approach to potential standard setting on this topic, which was consistent with the feedback that we heard. And I think another thing that was noted on this approach in the comment letters and feedback we received was that if the FASB were to pursue an approach like approach 2 in the ITC, that there would need to be close coordination with the SEC given the current existing framework under their guidance. So we can move on to the next slide. So we wanted to highlight the private company specific feedback that we heard on this project. First, we did hear that it may not be as common for private companies to provide KPIs as it is for public companies. And then the feedback was mixed on prioritization of a project for private companies. We heard that some respondents mentioned that the priority should be low because users have access to management and can obtain the information through those means versus requiring private companies to provide KPIs. Others noted that because private companies don't comply with the existing SEC framework, that maybe a project on KPI should be a priority for private companies to increase the transparency of that information that may not be available currently. And then I'll also note that a few observed that disclosure should be optional if they were to apply to private companies, which I think is important for private companies, but also is consistent with some of the feedback I mentioned earlier for the other approaches to potential standard setting that we did hear that disclosures should be optional rather than required. So with that, I will turn it over to PCC members if you have any questions, or if any board members want to share also some of their thoughts or additional context from
from our discussion earlier this week. Thank you.
Brad?
Yeah, just on that last slide where it says it's uncommon for private companies to publish KPIs. What do we mean by publish KPIs?
So for public companies, we're looking at websites, announcements, earnings releases. There's a really big population of where we're seeing these KPIs. And I think it was that for PCC companies, they may be commonly provided for debt agreements or certain one-off requests for that information, but not as publicly available. So that was, I think, the context of that feedback received.
Okay, yeah, and I would agree with that. Also, I'd agree with the point where the private company investors have better access to management. One of the things, again, with our survey is we just got a lot of companies that actually sent us the reporting packages that they provide to their private equity investors. Those are full of KPIs, but again, they're not being published, but the investors are getting them already. So I think that's a right point that you've got here.
David F.
I mean, in a way, I think private companies already have the ability to have optional disclosure of KPIs. What we've seen is non-required supplemental information in the financial statements as a supplemental schedule that includes what management may consider to be relevant information. Now, from a practitioner standpoint, we may either pursue providing an opinion on that or disclaim that supplemental information as a whole. So it's still there, it's still available, it can be published, and I don't think any standard, especially when you go to saying it's an optional requirement, the only thing you're really adding is the ability to include it in their footnotes instead of, separate from their footnotes in its own section. And then requiring the practitioner to actually fully opine on that information.
Katina?
Yeah, David, I agree with you. That's exactly what we see too. And I would say that generally when it's included, it's oftentimes at the request of, that there's some sort of like adjusted EBITDA situation that's required for one of their bank covenant calculations. And so even then it wouldn't necessarily follow the exact EBITDA, the kind of the standard EBITDA definition. There's quite a few add backs that would align with whatever their debt covenant, however it's defined in their debt agreement.
Robert?
In my experience, this is the one area that credit officers exercise creativity, trying to come up with their own little unique KPI that gives the absolute answer for all the things associated with the company. I don't know the standard KPIs would affect it would damper their enthusiasm, I'm afraid, for being creative here.
David Pesch?
I think also when you look at user aspect of this, we all have to Robert's point, I mean, we all have our own KPIs we've created that are more meaningful for what we're looking for and what we're looking at. And I think in today's age of financial analysis that we do, we're taking the financial statement data, we're entering it into an underwriting system that's producing those important KPIs for us automatically on every single financial statement. So to add them to an actual financial statement, I think that there's probably no benefit. There's no benefit to me. I get them, and I get the ones that I have 27 that come out. Some of them are standard, some of them are not. But I have 27 key KPIs that come out of my system that I look at. And my other point here is putting a KPI on a statement date, that's probably not decision useful information, because you now need to look at what they were before and what's the trend of those KPIs. So again, now you've got to, I just don't see a lot of decision useful information of putting KPIs in private company financial statements when the creditors are doing it themselves in their own format.
So would a consensus of this group be that in a vacuum, we wouldn't want the FASB to do more research on private company KPIs in a vacuum? That us saying, oh, we think that's great for private companies We would not say that. Would we want private companies to be excluded if a standard ultimately required them? Dave?
I certainly don't. To my comments, I certainly would be supporting that path, like a private company exclusion if we
Got
went
it.
to standardized KPIs. There's no cost benefit in my mind.
Holly?
I think it depends on where the standard goes. I mean, if you're taking the approach where you're defining a couple of the key things like EBITDA and free cash flow, I mean, then I think it would be good to, ensure that all companies are following those definitions. So I think it just depends on where the standard ends up.
So your view would be about how comprehensive the requirements are, probably, or how? Mike?
I guess I would try to make it optional if that were not to exclude them, but I think there is, if everybody rests on or comes to a consensus on a definition, there is benefit to that. So if they want to optionally elect into that, I think that that's useful. It's kind of like EPS. I mean, I don't know how many private companies follow some form of earnings per unit or earnings per share, but it's one of those calculations that are very complex, right?
Robert?
Exactly what Holly said. For a few high level like EBITDA, free cash flow, it's nice to know that everybody does those the same, but it's only a handful at the top of the house in my mind.
David?
I mean, I think there need to be a lot of research in what those real top ones are and the relevance and value to private companies on some of those. I mean, from a public investor standpoint, I think some of those may have more value because it's a way to see the insight. But for private companies, I don't think there's as much value on some of those, and which ones really have the value and are worth the cost benefit of having those. So, I mean, that would be what I would consider.
Thank you. Adam Rourke?
Yeah, I struggle trying to think there would be a lot of value in a standard definition for things like EBITDA unless all the lenders agreed that they were going to use said definition. It's pretty common to each entity having its own adjusted EBITDA calculation, and for them that is EBITDA. So I just don't see a lot of potential value here.
Thank you. David H?
I'd say the one downside of requiring it or optional is that all of a sudden the work isn't in providing the KPI. It's then all the footnotes of why their KPI is so bad compared to their competitors. And so they're just going to spend a bunch of time trying to convince whoever's looking at the KPI that they're different, right? And so that's where the time is going to be spent. That's why our covenants are, custom to the different types of businesses and even the kind of companies within those businesses. So I think you're just going to get a lot of additional work around providing details of why they really think their EBITDA is twice what the definition that is standard is going to be.
Thanks for that. A lot of dancing going on. Okay. Think you guys have the feedback you needed? Great. Thank you. And now the team will come in for accounting for and disclosure of intangibles. Katrina, you ready to go?
Oh, thank you. So this is a slide we've talked with you all about before. It probably looks familiar. It's just highlighting the journey that the board has been on with intangibles and some of the milestones from the project. And we talked with you all about intangibles in December, right before we issued the ITC. We received 43 comment letters on this topic, and the board talked about this, the feedback that we received on Wednesday. So during this discussion, we'll focus on the feedback that we received mostly and then touch on what the board mentioned on Wednesday as well. On the next slide, this is just a reminder of the purpose of the ITC. We issued it to solicit broad stakeholder feedback on whether or not a project on intangibles should be pursued. And from a key takeaways perspective,
The main feedback or main takeaway from the feedback that we received is that stakeholder views on this topic continue to be diverse and consistent with what we've heard in the past. Comment letter respondents provided mixed views on whether a project should be pursued on intangibles, and if it should be pursued, what intangibles should be looked at and how they should be resolved. Only one respondent provided feedback that supported broad reconsideration of the accounting for all intangibles. And most did provide feedback on whether and how the board should align the recognition criteria for acquired and internally developed intangibles, but their views were mixed on whether or not that should actually be pursued, and if so, how it should be pursued. We did receive a lot of support or people that suggested enhancing disclosures related to internally developed intangibles and R&D. Many of those were related to disaggregation. And then we did receive a lot of suggestions for targeted improvements related to the intangibles guidance as well. As it relates specifically to research and development, we had some specific questions in the ITC related to the definition of research and development, the accounting for research and development, as well as operability and auditability. For the definition, some people said that the definition is insufficient just because of modern innovations in the space. And some did recommend updating the examples of R&D activities that are included in the codification as well. And then for accounting for R&D, some supported the current expense model and others supported capitalizing development costs. And then as it relates to operability and auditability, respondents indicated that judgment is required to determine what is actually R&D, but generally there are no issues in exercising that judgment. We also had some questions in the ITC related to the recognition of internally developed intangibles. And that's on the, thank you. And there overall was very little support for the board to take a project on related to this topic. And then on the next slide, for the alignment of recognition criteria for acquired and internally developed intangibles, like I mentioned, this was the most commented on area in the ITC. And the questions that we had in the ITC related to this related to how the recognition criteria should be aligned, and provided some different models for consideration. But again, similar to every other topic that we had in the ITC, there was diverse feedback on this, and generally no consensus was reached on what should be done. But the respondents who did provide feedback, there was, we're still on the left. Sorry, thank you. The majority of respondents who commented on this topic did support some level of alignment. And for those that did support alignment, they either suggested aligning acquired intangibles or just aligning acquired IPR&D. And some did suggest an overall holistic alignment of the acquisition models as well. And then as it relates to presentation and disclosure, we did receive diverse feedback here too. Some suggested disclosures related to internally developed intangibles as well as research and development. But like I mentioned before, a lot of those related to disaggregation of information in the financial statements. And some comment letter respondents also suggested that we consider the work done by the CFA Institute as well as EFRAG when making these potential changes here. And then as it relates to investors, respondents generally indicated that investors are routinely making pro forma adjustments for amortization and impairment expense attributed to acquired intangibles, but most were not actually supportive of changing the accounting requirements to accommodate those particular adjustments. And investors did support the current accounting requirements for research and development, but they did suggest enhancing disclosures in that area related to research and development, internally developed intangibles, as well as acquired intangibles. And based on the feedback we received as well, we don't think that they are interested in capitalizing any internally developed intangibles. And then from an other feedback perspective, there were several other targeted improvements suggested by stakeholders, and those included acquired IPR&D, accounting for goodwill, as well as some other areas of diversity in practice that we saw. And then from a private company feedback perspective, we did receive either feedback from private companies or folks that were making comments on behalf of private companies. And that feedback related mostly to the recognition of internally developed intangibles, as well as current GAAP accounting for intangibles. And related to additional recognition, respondents didn't believe that private companies should recognize internally developed intangibles because it wouldn't provide decision useful information and could increase cost complexity and subjectivity for companies. And then they also indicated that the current accounting for internally developed intangibles is appropriate. Just before we get into discussion as it relates to the board meeting from Wednesday, the board generally agreed with the feedback from respondents that a one-size-fits-all approach doesn't work for intangibles. And they provided input on where we should focus our future research. And that was around the definition of R&D, or research and development, and related disclosures, acquired intangibles, and advertising expense. And the board is going to consider the intangibles ITC feedback in conjunction with the agenda consultation ITC feedback in the future to determine if a project on intangibles should be prioritized, and if so, what the project or the project scope and objectives should be. So that takes us to our questions for you all on whether or not you agree with the private company feedback that we received, and if you have any other feedback for us to consider. Thank you.
Thanks, Katrina. So any questions or comments as how, what's going on right now might affect private companies and whether we have a dog in this hunt? Doug?
Yeah, just a quick question on the last slide here where it says current recognition model for acquired intangibles presents significant operability and auditability challenge. I can't pronounce that word, so I'm gonna stop trying. Do we have more context on what's creating specifically those challenges? Do we have more? I'd just be curious as to what those operability challenges are in practice for anyone who has more context there.
I think one of the examples that was given was related to the accounting for goodwill. Correct me if I'm wrong, but beyond that, they didn't mention anything else.
I mean, Doug, I didn't necessarily see in the comment letter, but I would assume the requirement in BizCom that you have to separately identify assets other than goodwill and independently fair value them. Usually gets the private company community engaged whenever they have to hire a valuation specialist, right?
No, that's helpful. That was my presumption. I just wanted to make sure that was the direction of where that feedback was coming from. So that's helpful.
David F.
I mean, to your question, Doug, from a practitioner standpoint, in-process R&D has been a pretty large challenge in an acquired business. In terms of figuring out what there is, what projects there are, and how to fair value those ones that are in process, and the probability of them being able to complete, go to market, and be able to retain or obtain the value that they've put in or have fair valued at that point. Obviously, in a business combination, they're buying them for their products and their potential R&D. So there is value there, but it becomes a big challenge as part of that process.
No, it's been a minute since, I mean, in a previous life, I did a whole mess of BizCom. So and that was in more of my public company days. So just out of curiosity, even, my experience with business combinations, particularly for acquired intangibles other than goodwill, is companies were hiring valuation specialists to put together cash flow and royalty models to calculate those and to put the relevance of that relative to should it all be goodwill? Should we carve out these separately identified intangibles and the auditability issues? So I guess from an operability standpoint, is this really a cost issue for private companies that are not engaging valuation specialists, and thus it's putting the burden on those private companies to do those analyses? Is it more that, or is it? I'm just curious as to when this comes up specific to private companies, because I feel like business combinations, and particularly the valuation of intangibles, is, and even IP R&D, to your point, I mean, there's assumptions that have to be created and ultimately audited and vetted and validated, but what's really driving the consternation? Is it the development of those assumptions? Is it the supporting them in an audit? I'm just curious.
Rich, did you have a?
Yeah, I was just going to observe the issue, fair valuing IPR&D isn't just the acquisition date. It's every date until you get rid of it or at least begin amortizing it and it goes down. So that's a recurring issue to the extent you have concerns about impairment.
David?
And kind of a follow up on that IP&R&D is it's contrary to most other business application and treatment of R&D costs as a whole anyway, at least from a GAAP standpoint. So, business that spends its time being an R&D shop that doesn't go through a business combination has high expense, nothing on its balance sheet to show for it. But you go through a business transaction and that thing's now being carried for, however long the estimated life is. So there's really a large disconnect when you try to do comparability between companies that are acquired and ones that will never go through acquisition for the same, cost and value that's already there.
Thank you. David P.
I'm curious if from the private company feedback, if there was commentary regarding annual impairment calculation being a problem. Like, is that one of the issues from the private company side, doing the impairment, the annual impairment?
No,
review?
so the ITC itself focused on the recognition of intangible assets and whether we had the appropriate pool. There were some one-off comments about impairment and subsequently applying an impairment model, but they weren't related to primarily private companies, and they were just maybe perhaps one-off comments.
Okay, all right, thank you. I just for while you're looking at this, I mean, what we're starting to see on the private company side is the election of the 10-year amortization is becoming more the norm than annual impairment view. So it's just simplified the accounting for them. So I was just curious if that was coming up still. So.
Where we did hear that, and I don't know if you talked about it in agenda consultation, but there were some comments in the goodwill section of the ITC there that focused on impairment in goodwill.
Thank you.
Cool. Oh, Adam.
That's typical. I felt like I should respond to Doug's question. Rich hit the nail on the head. It's that they don't want to spend the cost on the valuation work generally. Obviously, every entity is different, so some know it's a price for doing business and are happy to get it, and life is generally easier when that's done. Others really want to control costs and don't want to have to get separate valuations. That's why the PCC alternative for goodwill and customer relationships is so popular.
Okay. Then we're through the meat of the agenda, and now we give Nellie time to give us updates.
And I'm cognizant I'm between you and lunch and or your flights. So they will be quick updates. I do have 6 things to talk about, but they're short. First, on July 30th, which was after you met in June, the FASB issued Accounting Standards Update 2025-05, measurement of credit losses for accounts receivable and contract assets. Yay! I don't have to remind you all this, but for our audience, the PCC initiated that project in response to feedback from private company stakeholders about the cost of applying the CECL model. That guidance introduces a practical expedient that's available for all entities in an accounting policy election that's available for entities other than public business entities, related to applying the CECL model to current contract assets and current accounts receivable arising from transactions accounted for under Topic 606. For entities under public business entities, I will mention that the practical expedient and the accounting policy election are available to be elected on an evergreen basis. Specifically, the way we wrote that is that for those entities, making the election to apply those options after the effective date doesn't require a preferability analysis in accordance with Topic 250, but those can be available for folks. So we just wanted to let you all know that this was issued, that it's available for our stakeholders, and we really appreciate the PCC's feedback on this. and the ability to get it across the finish line, and we're really happy about this. I should have said this at the beginning, but I am happy to talk about questions or if the board members want to add anything as we go through this. The next item I have to mention is another update that was issued earlier this year, update 2025-04, clarifications on share-based consideration payable to a customer. So this transaction happens when an entity offers something to its customer to incentivize the customer to buy goods or services, but the something in this case is share-based payments like warrants, whatever else. These items usually vest on the grantee, who is the customer purchasing goods or services. And the guidance makes clarifications to what we're seeking to avoid is delaying revenue recognition for the issuances of things that aren't expected to vest, which was causing challenges with the financial reporting outcomes. We also think it'll reduce diversity in practice for these items and kind of make the guidance more operable. The specific clarifications were to the master glossary term for performance condition, to the election for related to forfeitures, for service conditions, for share-based consideration payable to a customer, not for employee or non-employee awards. So we can go through those. We talked through this project with the PCC in the March meeting. That was while we were kind of in the redeliberations phase of the project, but now it's been issued. So we wanted to mention it again. And as we've shared previously, we received feedback in the comment letter process that this was a transaction that happens within private companies or among private companies. And that's why we wanted to remind both the PCC and our stakeholders that this guidance has been issued and is available, and it's effective for calendar year end entities in 2027. Okay, 2 down. The next 2 I have to talk about are EITF issues. The first one is an upcoming exposure draft. So earlier this year, the EITF added a project to its agenda about the initial measurement of paid-in-kind dividends on equity classified preferred stock. Classic for the EITF. It's a pretty targeted issue. We discussed this project with the PCC in June, but we're just giving you a quick update. This is situations where an entity is paying a dividend on their preferred stock, but in additional shares, in increasing the liquidation value of the preferred stock, something like that. The EITF recommended and the board's exposure draft will propose to measure these at the basis of that liquidation preference increase or what is specified by the preferred stock agreement. One thing we've observed for over time is the importance of the PCC weighing in on these projects that are not specific to private companies. This PIK dividends guidance is for all entities, but we hear that we get valuable input on these from the PCC. And in June, one of the things we specifically talked about was it can be helpful for the PCC to weigh in on the disclosure aspect in particular. It can be difficult to address the operability or reduce the cost of applying disclosures in hindsight or in retrospect going back through. We've had some challenges doing that over time, but we can proactively talk about private company differences in disclosures or something else like that. And in this case, I'm here to say the exposure draft in this one doesn't have any additional disclosures to talk about. So we would bring that to you if it was something we wanted your feedback on or we thought the PCC's input could help there, but this one is just the measurement guidance, except for the in transition. The comment period for this narrow EITF issue is 25 days. We're hoping the exposure draft will be issued shortly, and we're looking forward to that. My next update is another EITF project, market return cash balance plans. This is a type of pension plan and a type of cash balance plan in particular. They're currently accounted for as defined benefit plans. We also talked about this in June. We can go over more background if folks want to get caught back up if that's helpful. But the EITF talked about this at their meeting in September and developed a recommendation for the board. So that's the update now that this is continuing to move forward. For the EITF kind of recommended a definition of a market return cash balance plan and specified that for those types of plans, it would be appropriate to set the discount rate equal to the assumed interest crediting rate so that then the liability and the assets kind of have comparable measurement basis. That discount rate disconnect was the main challenge that had been observed in the agenda request and that we talked through. In a low interest rate environment, that can result in very different asset and liabilities. And the change recommended by the EITF should help address the financial reporting issue. So the ITF's recommendation on this will now come back to the board for the board to decide to whether to add a project to their agenda and then potentially to move towards an exposure draft. Similar to the PIK dividends project, we expect this to clarify the guidance, but potentially not add significant incremental disclosures. Our research on the prevalence of market return cash balance plans does indicate that they may exist for some smaller companies, but when we talked to you all about this in June, we had kind of mixed feedback on how common these are or how frequent. The project is kind of continuing to move forward. We're interested in any additional feedback or perspectives, or if you come across these or have any other observations about the prevalence or the accounting that the EITF has recommended. Take a breath. 2/3 of the way there. And my next update is on the Environmental Credit Programs project. We discussed this project with the PCC in the past, but it's been a while, a couple of years now. So in August of this year, the board redeliberated this project. The team's in the process of drafting the final update, but I'll level set a little bit on what this project is addressing. We're talking about the accounting for both the environmental credits and environmental credit obligations. And I think it's helpful in talking about this project to also kind of touch on what the project doesn't do. It doesn't address the accounting for carbon emissions. It doesn't address sustainability reporting. It doesn't do anything like that. Those topics are beyond the FASB's mission, which is focused on financial accounting and reporting. However, some entities are buying these credits or subject to these regulatory programs, and therefore there's a financial reporting transaction, like you've paid cash to buy a credit, and that's what this project addresses. So the proposed update on this topic was in 2024, and as I mentioned, the redeliberations were in August. The guidance defines the types of credits that are in the scope of the project. It'll include common items, renewable energy credits or RECs, renewable identification numbers or RINs, carbon offset type credits. Those types of things are in the scope. The obligations are limited to regulatory programs. At a high level, the guidance requires an entity to account for the credits based on how an entity intends to use the credits. We group the credits into compliance, non-compliance, and voluntary type credits. So an entity is first assessing whether it's probable that the credit will be used to either be sold or to settle an environmental credit obligation. And if it makes it into that category, if it's probable individually of being used to settle an environmental credit obligation, it'll be a compliance credit recognized on the balance sheet, not tested for impairment. If it's probable of being either sold or used to settle an obligation, that'll be recognized on the balance sheet, tested for impairment. And the credits that are not probable of either being used to settle an obligation or sold are voluntary credits, and those are expenses incurred. No major changes to that piece of the guidance in the redeliberations process. On the liability side, again, this relates to enforceable obligations arising from a regulatory compliance program. And if so, the obligations are measured assuming that the end of the reporting period is the end of the compliance period. And then the liability is measured in two pieces, funded and unfunded. So on the funded side, if an entity has compliance credits that it's going to use to settle that obligation, the obligation is measured at the amount of those credits. And then the unfunded portion, to the extent there is any, is measured at the fair value of the credits that would need to be obtained. The proposed update to our comment about disclosures had fairly extensive disclosure requirements in it. This was the source of a lot of comment letter feedback from our stakeholders, not just private company stakeholders, but kind of across the board. And the board did make a few changes to those disclosures in redeliberations. So the disclosures are required for annual periods. The quantitative disclosures that are required include the amount of environmental credits that are recognized as kind of assets or expenses, disclosures about the change in the intended use of the credits, but there were a few things in the exposure draft, like a significant holdings disclosure, some disclosures about revenue from the sales of credits and other kind of P&L type items like that, that the board concluded were too detailed for this type of accounting. So because the board reduced the amount of disclosures during that redeliberations, they concluded not to have any private company differences for these disclosures, but overall with that kind of reduction in the amount of disclosures there. So we're looking forward to the final guidance in this area. We hope that it is helpful clarity for entities that enter into these transactions. and moving forward with that. Last but not least, this actually came up earlier. We wanted to mention a research project that was recently added to the research agenda. As part of the agenda consultation, as you saw, we got a lot of feedback on digital assets. We did a project on digital assets with the final update in 2023, but that really focused on the subsequent measurement of these credits at fair value. That was an important clarification, and that guidance has been pretty well received. Specifically, we're getting feedback that there's some additional elements of these transactions that may benefit from additional accounting guidance. Specifically, we've heard there are some crypto lending transactions that may benefit from some additional clarity around the derecognition accounting. And then we've heard certain questions arising about certain digital payment type assets, maybe stable coins, that whether those are classified as cash equivalents or not. As part of this feedback on digital assets, earlier this summer, the Presidential Working Group on Digital Asset Markets did release a report that referred some of these issues to the FASB for standard setting. So that's part of what we're looking at here, includes those ones I just mentioned. We're actively working on the research in this area. We hope to bring this to the board and potentially to the PCC to weigh in the future. Those are my updates. Exciting stuff. Thank you.
Thank you, Nellie. Any questions or comments or feedback to Nellie on those 6 topics? Are there other things that, have come up in the last couple of days that you want the FASB staff to be thinking about or potentially talking to us about in the future? Okay, so one announcement, I think, word of mouth, we probably have heard that Robert Messer retired from his role at the bank. I hear he's becoming slave labor through his son, but I didn't hear that from him. His son has an accounting practice, and I think you're going to be doing the photocopying or something.
Well, he's already discussed the performance reviews and termination. And I said, well, you're going to have to start paying me before you can fire me. And we may need a, ruling of some sort on that.
Well, so I also heard, and this is, I'm very excited for him. Robert is taking off on a lone trip on the Camino de Santiago in a week. He's leaving next Friday, I think, to spend 2 weeks in Spain doing a pilgrimage to see if St. James is really buried there. So good luck with that. Congratulations. Any other questions or comments? Well, great. Thanks for a very robust 2 days. Appreciate your dialogue and feedback. It's been one of the best meetings we've had in my view. Safe travels, and we'll see you in December.